So hello all my dearest students of South India. I hope you all are doing good. I hope your studies are going on great for your upcoming exams. So today we have come up over here for another video which is going to be a very important video for your examination. That is the compilation of past 7 attempts exam paper in a span of around 1.5 hours to 2 hours. Just a week before, I have put a compilation for you all in full English for the past 8 RTPs including the May 2024. In the same way, we are going to put a compilation of the past 7 attempt papers for CA Final Direct Tax relevant for May 24 and November 24 exams. Okay. So without wasting any further time, let us start with the first paper, and that is the Jan 2021 paper is going to be the first paper that we are going to discuss over here. And the very first question over here is a PGBP question, total income question. Assessee is a manufacturer and you have to solve this question as per the normal provision. You are not supposed to opt 115 BAA. You are not supposed to follow MAT. Solve as per normal provision, and therefore if you solve as per normal provision, the turnover of last to last year is greater than 400 crore. Therefore the tax rate of the assessee will be 30%. Okay. Now you have to compute the total income as per the normal provision, and then we'll compute the tax also as per the normal provision. Okay. Now very first adjustment over here, the first thing which we have written over there over here is the assessee is a manufacturing assessee. Now the net profit of the assessee is 75 lakhs and it is after debit and credit of the following items. Now the very first item over here is there is some interest cost till last year what used to happen and what is happening in the current year. Let me give you a brief idea about it. Till last year, interest was taken as a part of stock. Okay. The company was used to take interest as a part of opening stock and closing stock, which is wrong. The accounting standard says that interest cannot be part of opening and closing stock. Even the ICDS says that interest cannot be part of opening and closing stock. So that mistake which the company was doing till the last year, that is 22-23, the company rectified that mistake in the current year. The company has also given the effect of that in the P&L, and because of that the profit of the company is decreased by 13.5 lakhs. Now the question is, if everything is done correctly by the company in the current year, why the hell I am going to give any effect? So in adjustment number 1, because everything is done correctly by the company, you are not going to give any effect in adjustment number 1 over here. Okay. Second adjustment is a routine adjustment. There is a provision for payment of gratuity. Now whatever provision is made as per actuary, that is disallowed as per section 48(7). So you will disallow 5 lakh rupees, and whatever is actually paid is 1,20,000. That will be allowed under the income tax law. Okay. Now the third adjustment is the company has paid some one-time license franchise fee of 20 lakh rupees, and that is debited to the P&L. Now my question to you all is that franchise fee and all is an intangible asset. Why the hell the company is debiting that to P&L? So therefore you have to disallow that 20 lakh rupees, and then you have to claim 25% depreciation on that. Full depreciation will be allowed because it is purchased on 16th of August. Therefore it is put to use for more than or equal to 180 days. Therefore you can claim full depreciation. Okay. Next adjustment is a very simple adjustment. There was some cash which is lost because of the theft of 12 lakh rupees. Now if the cash is lost by theft, that is allowed as a revenue loss. The Supreme Court has held in the case of Badridas Daga versus CIT, that is the trading losses which are incidental to the business of the assessee shall be allowed as deduction. Therefore, this being a trading loss, it will be allowed as a deduction. There is nothing wrong in this. Okay. The next adjustment is a beautiful adjustment. On 1st December 2023, the company has paid a royalty of 3 lakh rupees to Mr. Roser, a non-resident. Okay. Now, the company has done what? The company has deducted the TDS, but unfortunately, the company has not deposited the TDS till the due date of filing of return. Company has deducted the TDS, but the company has not deposited the TDS. So the company has made the default of not paying the TDS on time. Therefore, this 3 lakh rupees will be what? It will be disallowed. And entire 100% will be disallowed because it is paid to a non-resident. And if you pay to non-resident and if you do not deduct the TDS, entire 100% is disallowed under the income tax law. Now the question over here is, you would say that, sir, if the other person that Mr. Roser has submitted the return, sir, he has also included that income in the 3 lakh rupees in his return of income, sir. So, sir, in that case, it is deemed, sir, that the person who has paid, he has deducted, he has paid. No, it's not like that. When I can say that I have deducted and I have paid, when 3 conditions are fulfilled by Mr. Roser. First, Mr. Roser has to include that 3 lakh in his income. He has done that. Second, Mr. Roser has to file the return. He has filed that. Third, Mr. Roser has to pay tax on that. Mr. Roser is not paying tax on that. In fact, Mr. Roser is claiming refund of 20,000 rupees by claiming some expenses. He is claiming a refund. Therefore, I cannot claim that what? That Mr. Roser has done the things correctly. Therefore, I can claim the deduction. Even if Mr. Roser would have deducted the tax, even if Mr. Roser would have paid the tax, then also I could not get the deduction in the current year, because in that case, the kharcha, the expenditure is disallowed in the current year and it is only allowed in the next year, because it is deemed that Mr. Roser has paid the tax. Mr. Roser has paid the tax on the date of filing of return. In that case, I will not, even if Mr. Roser would have paid the tax instead of getting the refund, I would have not got the deduction in the current year. I would have got the deduction in the subsequent year also. We have done sufficient adjustments based on this. So this is a beautiful adjustment. Adjustment number 5, mark it down please. Next one is a very routine adjustment. You are selling some plot of land, 100% holding subsidiary are selling some plot of land, then it is exempt. If there is a transfer of capital asset by 100% holding to a subsidiary or 100% subsidiary to a holding, it is exempt. The only condition is the recipient, the transferee should be an Indian company. Here the transferee is an Indian company, therefore it is exempt under section 47. Okay. Next one, the company has obtained a loan of 5 lakh rupees from a textile company, that is a private company, and this company, that is the SSC, holds what? 68% voting rights in that company. Now that company is a closely held company. Manu Textile Private Limited is a closely held company, and if any person holds 10% or more of the voting rights of any closely held company, and if that closely held company gives a loan to the shareholder, then it is deemed dividend. But deemed dividend cannot be more than the accumulated profits. Therefore, this company has given a loan of 5 lakhs, but the accumulated profit is only 2 lakhs. Therefore, 2 lakhs will be deemed dividend under income from other source in the hands of the SSC. Okay. Next one is again a very important adjustment. The company has purchased a motor car on 23rd of August 2019. Do you remember something important about this date? If any person, if any SSC has purchased and put to use a motor vehicle from 23rd of August 2019 to 31st of March 2020, then you will get 15% extra depreciation. Do you remember that or not? So you can claim 15% extra depreciation on that. And why you should claim? Because it is not debited to P&L. This vehicle's depreciation is not debited to P&L, and therefore you will claim 15% extra depreciation on this particular vehicle. Okay. So you can claim 30% depreciation on 12,80,000 in this current year. Okay. Now last adjustment over here is which is on 80 JJAA. The number of employees at the beginning of the year were 480. Then company hired 120 employees, and then the company fired 70 employees, and therefore the overall strength is what? 530. Remember, 80 JJAA is available only if your overall strength is increasing. If your overall strength is not increasing, 80 JJAA will not be available. In this case, the overall strength is increasing, therefore the company will get the deduction. How much deduction the company will get? 120 employees are hired on 1st of July at an emolument of less than 25,000 rupees. So therefore it is less than up to 25,000. Therefore it is eligible. If the emolument is more than 25,000, then the SSC is not eligible. Therefore here how much deduction will be available? 120 employees are newly hired. 9 months they will be working in the company. 15,000 is their emolument, multiplied by 30%. That much will be the deduction that the company will be getting under 80 JJAA. Okay. I hope it is clear to all of you. Then you have to compute your total income, and then you have to compute your tax payable. Okay. Tax payable is 30%, as I have told you at the beginning of the question itself, because the turnover of last year is greater than 400 crore. Therefore, the tax payable is what? Tax payable will be 30%. I hope it is clear to all of you. Okay. Surcharge is not applicable because the total income is less than 1 crore. Therefore, surcharge will not be applicable in this case. Okay. Let's move on to the next question. Question number 2, part number A. What is there in this question? It's a very simple question. There is an LLP who is claiming some deduction under 10AA of SEZ. Okay. Apart from that, the SSC is also claiming some deduction of warehousing of agricultural produce. Therefore, the SSC is also engaged in 35AD business. So the SSC is claiming 10AA. The SSC is also claiming 35AD. For the purpose of 35AD, the SSC has incurred a capital expenditure of 75 lakhs, out of which land is 10 lakh rupees. Okay. Let me read the question first. Now. We need to compute the income tax of the SSC, including the AMT under 115JC. So now, for a partnership firm, you have to compute 2 tax. One as per the normal provision, one as per 115JC, alternate minimum tax. Now, let me compute as per normal provision. As per normal provision, what will be the tax calculation? First of all, profit from SEZ, 50 lakhs. Okay. Now, whatever is the profit from SEZ, we have to write down that. From that, we will take the deduction of SEZ. How much deduction of SEZ? Export profit into profit from export into export turnover divided by total turnover. How much is the profit from export? Profit from export is 50 lakh rupees. What is the total turnover? The total turnover is 1 crore, 80 plus 20. What is the export turnover? Export turnover is 80 lakhs. So multiply by 80, divide by 100, that will give me the 10AA deduction. Okay. Then what is the deduction for 35AD? The profit from 35AD business is 1 crore 5 lakhs. Out of which you have incurred an expenditure of 75 lakhs, but land is not allowed as a deduction. Therefore, 65 lakhs will be allowed as a deduction to you under the income tax law. Okay. So 1 crore 5 lakhs minus 65 lakhs. This will give you your net profit as per 35AD. Then you compute tax as per 30% for the tax rate for the partnership firm is 30% plus surcharge says whatever is there, you apply that. Okay. Now, the big question over here is, pay attention please. Now we will come to 115JC. In 115JC, what the SSC has to do? The SSC has to compute the adjusted total income. What is adjusted total income? Whatever is the total income as per the normal provision, add what? Add 2 things. That is First add 10 AA deduction. Whatever deduction you have claimed over here, you have to add back that. Then you have to add the deduction claim under 35AD, add 65 lakhs, and then you have to reduce the depreciation on that 65 lakhs. Suppose this is a building, so you have to reduce 10% depreciation on that. For 35AD, you have to add 35AD deduction, and then you also have to reduce the depreciation on that particular asset. That will give you adjusted total income. Then 18.5% tax. If surcharge is applicable, apply surcharge also. If the income exceeds 1 crore, 12% surcharge and 4% cess. Then compare both the tax, whichever is higher. If AMT is higher, pay AMT, and the difference between the AMT and the normal tax will be considered as what? AMT credit. I hope it is clear to all of you. The next question is again a beautiful question. Question number 2B. Vioni Inc. is a non-resident and a foreign company. So how did you come to know it is a non-resident? First of all, it is incorporated in Japan. Therefore, it is a non-resident. Sir, it can become resident also because of poem also, na? No. Because of poem also, it is not resident. Sir, they are coming to India for some meeting. They are coming to India for meeting, not for the purpose of what? Making any commercial or management decision. They are coming to India for what? For sale of company. And remember, sale of company does not amount to what? Does not amount to commercial management and decision of the business. Therefore, what is poem? Poem means a place where key management and commercial decisions are taken. There is a CBDT circular which says that under the poem guideline that if the company, if the shareholders are coming, if the company is taking decision to sell one of the parts of the company, that does not mean the company has poem in India. Therefore, this company is a non-resident. So you have to answer the question according to the non-resident status only. The very first question, the very first point over here is the company has received a dividend declared by Miami Inc. That is a Japanese company which has declared a dividend of 54,000 rupees to the company. Now that Japanese company has 70% assets located in India. Okay. Now this is the classic case of Vodafone case law. CGP has substantial assets located in India. Then in that case, if CGP sell the shares, then if you sell the shares of CGP, then capital gains is chargeable in India. But if CGP gives dividend to another company, then that is not taxable in India. Do you remember that or not? That the shares of CGP derive its value substantially from asset located in India. Yes, the shares of Miami derived its value substantially from asset located in India. I agree to that, but that is only applicable for capital gain taxation. That is not applicable for dividend taxation. Therefore, any dividend declared by Miami to Vioni will be exempt under the income tax law. That will not be subject to tax. Okay. Second, some assessee, the non-resident is providing some services to government of India, and government is utilizing that FTS outside India, that is in Nepal. Whether that FTS will be taxable in the hands of non-resident or not. Vioni is providing services to government, and Vioni is paying what? And government is paying what? Government is paying the FTS, but those services are utilized outside India, and the answer is yes. As per 917, it is deemed to accrue or rise in India. But you will make an argument, sir, but the services are not utilized in India. Services should be utilized in India. That condition is applicable for residents. That condition is not applicable to government. If a government is taking any services and paying royalty, FTS or interest, then it is always deemed to accrue or rise in India, irrespective of where it is utilized. If it is utilized in India or even if it is utilized outside India, it doesn't matter. In case of government, it is always deemed to accrue or rise in India. Okay. The third one. Vioni is giving some loan to a unit of an IFSC located in India. So Vioni is giving loan to IFSC unit, and IFSC unit is making some payment of interest. Then it is exempt under section 1015 if the loan is given on or after 1st September 2019. If a loan is given on or after 1st September 2019, then it is exempt under income tax law. And the fourth point is a very simple point, which is a grandfathering clause. I hope we have done sufficient examples on grandfathering. You can see that here. Whenever the market value of the shares on 31st Jan 2018 will be given, you have to apply grandfathering clause. And for that, how will you determine the cost? The cost will be the actual cost compared with lower of FMV on 31st Jan or sale price, and then whatever is higher, that will become your cost of acquisition. Okay. So I'm not wasting much time on this particular question. Okay. Now coming to the next question. The next question is a charitable trust question. So GNK charitable trust, which is following accrual system of accounting. I have no harm if they follow accrual system of accounting. They can follow accrual system of accounting. But last year Finance Act 2022 has made an amendment that if you want a deduction of your application, then the application must be paid. It will not be allowed. The deductions will not be allowed on accrual basis. The deductions will be allowed only on what basis? Payment basis. So accordingly, you have to answer this particular question. Okay. Now let us compute the total income and the tax payable of this particular tax liability of this particular trust. Okay. Now the very first thing is they are receiving some gross receipt of 24,41,000. Let's write down that first. Then they are receiving some voluntary donation. In that voluntary donation, there is an anonymous donation of 1,85,000. Therefore, how much is normal donation? Normal donation is 3,35,000. Let us write down that first. Okay. Now, what is the treatment of anonymous donation? Listen, anonymous donation is exempt subject to what? 1 lakh or 5% of total donation, whichever is higher. Therefore, 1 lakh or 1 lakh or 5% of donation, whichever is higher, that will be exempt, and the balance will be taxable at how much? 30%. Be very careful, okay? So out of 1,85,000, 1 lakh or 5% of total donation, whichever is higher, will be exempt, and balance will be taxable at what? Balance will be taxable at what? 30%. Now this 1 lakh also should be added to this which is getting exempt under 115 BBC. The anonymous donation which is getting exempt under 115 BBC should be added to the normal income statement, and this will be taxable at what? This will be taxable at this. You have to add to the normal income statement, and then you take 15%, you can apply that money, and then that will be taxable at slab rates, okay? So you have to be very careful with this. Then dividend from Indian company, you have to add to the income statement. Income from mutual fund, you have to add to the income statement. Agriculture income is exempt even for the trust. For trust also agriculture income is exempt. Then you take 15% exemption, that is section 11(1) exemption, and then you see what all application you have made. First, you are setting aside some amount for the next 4 years. Yes, you can claim an exemption under section 11 subsection 2. You can accumulate for 5 years, and you can take the deduction today itself. Second, you are making some payment to one of the trustee of 1,47,000. The market value is 2,50,000. So there is no harm. You are paying less only. You are not paying more. You are paying less. So it's okay. You can make the payment to trustee for the rent. You have taken something on rent, and you are paying on rent. You are paying the rent, and the rent is less than the market value. You are not paying excess rent. So that is allowed. Okay. You are making some payment to foreign teachers. Okay, it is allowed. 1,96,000, that will be allowed. That is again for the objects of the trust. And you are making some expenses for objects of the trust. Again, that is allowed. But assuming that all of them are paid, unless it is paid, it will not be allowed as a reduction. Okay. Now after doing all these things, you have to add this 85,000 at the end. At the end, you have to add this 85,000 rupees. Okay. This will be taxable at 30%, and the balance income will be taxable at slab rates. Okay. Slab rates, you can follow the old regime also. You can follow the new regime also. In this question, we are following the old regime. So according to old regime, we are solving this question. Okay. Now next question is a very simple DTAA question. I'm not going to waste much time on this particular question. The SSC, I'll tell you the important points of this question. The SSC is a 65 years old person, and he's a resident person. Therefore, you need to be careful with few things. Because he is a 65-year person, senior citizen and resident, he will be getting 80 TTB deduction of 50,000 rupees. You have to be very careful with this. And he will also be getting obviously 1,50,000 in PPF. And that is the only thing apart from this. This is a very routine and simple question, nothing great as such. So I'm not wasting much time on this. DTAA question, if something new comes, I will be definitely discussing with you all. Okay. Now, question number 4, which is on TDS. Okay. The SSC has made some bank guarantee commission to the bank. So SSC is making some payment of bank guarantee commission to the bank. So whether that will be subject to TDS, and the answer is no. If you make any payment to bank, then that is not subject to TDS. There is a CBDT notification also on the same. We have also done this discussion in the class. If you make any payment, we are no one to deduct the tax of the banking industry. Please, bank is a very organized sector. We cannot deduct tax of bank. Therefore, no TDS if you make the payment to bank. Okay. So in this case, there is no need to deduct any TDS. Next question, study card. Study card, an online education provider. Okay. It's an Indian entity. It's a trust in India. Now, Mr. Monty, a non-resident, has provided some web-based lectures. So Mr. Monty, who is a non-resident, it is providing some web-based lectures to whom? To study card. Whether that will be taxable in India. If it is taxable, we need to deduct TDS. If it is not taxable, we will not deduct the TDS. So there are two views which are taken by institute. Assuming that non-resident Monty, if it's providing the services, if it is a normal business, then it is not taxable. Why? Because for normal business, there has to be a permanent establishment in India. And Mr. Monty does not have a permanent establishment in India. Therefore, it is not taxable. And because it is not taxable, TDS is not applicable. But if it is not a normal business, the services which are provided by Mr. Monty comes under the definition of FTS, fees for technical service, then there is no need for any PE. Only you have to check the services are utilized in India. So if Monty, whatever Monty web-based lecture is providing, if it comes in the definition of FTS, then in that case, there is no need to have any permanent establishment. Only the services have to be utilized in India. And in that case, TDS has to be deducted under section 195, because in that case, FTS is deemed to accrue or arise in India. I hope it is clear to all of you. Now the third question, very simple question. Mr. Nitin's last year turnover is less than 1 crore rupees. Now if Mr. Nitin's last year turnover is less than 1 crore rupees, therefore 194C is not applicable to individual HUF. Individual HUF is liable for 194C only if the last year business turnover is greater than 1 crore or professional turnover is greater than 50 lakhs. Therefore Mr. Nitin is not liable for 194C. But Mr. Nitin is making a contract payment of 65 lakh rupees for repair of his office building. Whether 194M will be applicable? The answer is yes. Where 194C is not applicable, 194M is applicable for individual HUF if the aggregate payment in the entire year exceeds 50 lakh rupees. Here it is 65 lakhs. Therefore 5% TDS has to be deducted. Okay. Next one is a very simple question. Again and again, 100 times we have seen. The airline company has paid 10 lakh rupees to Airport Authority of India for landing and parking charge. The TDS will be deducted under 194C at the rate of 2% because the Airport Authority of India is a company, and TDS will not be deducted under 194I. It is not a rent, it is a service. Therefore, TDS will be deducted under 194C. I hope it is clear to all of you. Next question is a beautiful question on transfer pricing. There is a company, Vihan Limited, which is an Indian company, which has given a loan of 6 crore rupees to another company, which is a resident of Singapore. So one is resident, one is non-resident. Vihan is resident and Yuan is what? Yuan is non-resident. Now, One company has given a loan to another company to the extent of 150% of the book value of the asset. How much loan is given? 6 crore. What is the book value of the asset? 4 crore. Therefore, the loan is given to the extent of how much? 150% of the book value of the assets. Therefore, is Johan and Vihan deemed to be a source enterprise? Yes, they are deemed to be a source enterprise. Is transfer pricing applicable between both of them? Yes, transfer pricing is applicable between both of them, because the law says that if one entity provides 51% of the financing of the book value of the assets of the another entity, then both of them are deemed to be a source enterprise. Sir, but it is written that later on the assets have revalued and it is increased by 2. It doesn't matter. It doesn't matter at what value it is revalued. What is relevant is only book value. You have to check the book value with the loan amount. The book value of the asset is this much, the loan amount is this much. Compare that. It has to be at least 51%. If it is 51%, both of them are deemed to be a source enterprise. Okay, I hope it is clear to all of you. So the first question, would Vihan and Johan be treated as a source enterprise? Yes, because the one entity has given a finance of 51% of the book value of another asset, another entity, therefore both of them are deemed to be a source enterprise. Yes, they are a source enterprise. Second, calculate the arm's length price of Vihan, which sells the same equipment at 9,000 per unit to Y and 9,500 per unit to X. Now listen carefully, please. Very important point. Now, Vihan has also entered into an agreement with Johan to sell some equipment at 7,400 per unit. So I am selling equipment to my associate enterprise. 20,000 medical equipment I am selling at 7,400 per unit. Therefore, is the transfer pricing applicable? Yes, applicable. So I went to the market. I got two arm's length price. One I am selling at what? I am selling at 9,000. Another I am selling at 9,500. Now range concept is not applicable. Range concept is applicable. There has to be at least 6 items. I have only 2 items. So I have to take what if range concept is not applicable? If there are less than 6 items, what am I supposed to do? I have to take an arithmetic mean of those 2 prices. So the arithmetic mean of 9,000 and 9,500 will come to how much? It will come to 9,250 rupees. Now I have to check the difference between this price and this actual price. It has to be at least 3%. Remember, it has to be at least 3% for arm's length price to a price. Is the difference between 9,250 and 7,400 greater than 3%? Yes, it is actually 25%. Therefore, my arm's length price will be how much? It will be 9,250, and I have to pay tax as per 9,250. 9,250 into 20,000 equipment, that will be my arm's length price. Okay. Now, what are the options available to Mr. Johan? And if the transfer pricing, if in respect of such increase in transfer price, if Vihan accepts such transfer price, see, whatever additions are made will be called as primary adjustment. Now, first option which Vihan has, he has to bring back the money to India. He has to bring back the money to India within 90 days from the due date of filing of return. This is the first option. If it doesn't bring back, then it will be deemed loan and secondary adjustment will be applicable. The second option which is available with Mr. Johan is he can pay one-time additional tax. 18% tax, 12% surcharge, 4% cess, and one-time additional tax, and he will be relieved from what? He will be relieved from the taxation. So this is what this question is all about. Next question is a very simple question, some practical questions based on what some case laws. The very first question over here is, can High Court recall its own order? High Court has passed an order. Now High Court feels that I have made some mistake. So can High Court recall the order and rectify the mistake? Rectify the apparent mistake, or can High Court recall the order and rectify the apparent mistake, or High Court recall the order and change its original decision? The Supreme Court of India has held that High Court can recall its own order or rectify what? An apparent mistake, and it can also review its own mistake. Okay, it can review the mistake and change the order. This power is there with the High Court. The High Court has been given this power. Okay, the next question is a case law which we have done a lot of time in the class of Ace Builders Limited. Now what has happened in this case? Listen carefully, please. This is also a case law of Dempo Limited, which is on 54 EC for block of assets. Remember. If I am selling a long-term block of building, so there is a block of asset building in the business, which is long-term, which is 10 years old, whether I will get the capital gains exemption under 54 EC. The law says that there has to be a transfer of long-term capital asset. The argument which was made by the assessing officer was the gain is short-term capital gains. But the assessee made an argument. The gain is short-term, but the asset is long-term. The asset which is there in the block is not short-term. It may be short-term, it may be long-term. If a building is 10 years old, then that building is obviously long-term. And 54 EC does not comment on the nature of gain. 54 EC comment on the nature of what? Asset. 54 EC says that if any capital gains arising from transfer of long-term capital asset, so even in the block of asset, the asset is a long-term capital asset if it is held for more than 24 months. Therefore, 54 EC exemption will be available even to block of assets if the assets are held for more than what? 24 months. If the building is held for more than 24 months, you will be eligible for 54 EC exemption. I hope it is clear to all of you. Next question is a question on cooperative society. A very simple question. A cooperative society is engaged in providing credit facility to members. Therefore, it is eligible for deduction under ATP. ATP is available to the assessee. Now, the very first point over here is the assessee has received from interest from other cooperative society. Whether this is eligible for ATP? Yes, it is eligible for ATP. See, because if a cooperative society gives loan to another cooperative society, earns interest from there, then it is eligible for deduction under ATP. Okay. Then it received interest from members. Yes, if the cooperative society gives loan to members on interest from there, then that is also eligible for ATP. It doesn't matter whether it is for personal purpose of the member or for some other purpose of the member. It doesn't matter. Then the cooperative society has earned some rental income. That rental income will be subject to tax. Okay, that is not subject to what? Deduction under ATP. That is subject to tax. But from that rental income, you can take 30% standard deduction. There is no harm in that. Then the cooperative society is engaged in some agency business. That agency business will also be subject to tax. You have incurred some expenses also on agency business. You can claim that expense also against your income. There is no harm in that. Then the cooperative society has earned some interest from the idle funds from the members. Again, if you are earning anything from members, then that is also exempt over here. ATP, you will get the deduction of this 2,04,000. Then at the end, you have some losses. You can take the set off of that loss. And last but not least, you have to compute the total income and tax payable of the cooperative society. But before computing the total income, one last thing that you have to take, because this is not a consumer cooperative society, it's a normal cooperative society. Therefore, you will get a general deduction of how much? 50,000 rupees over here. Because it is a normal cooperative society, you will get what? A general deduction of 50,000 rupees over here. And so you claim 50,000 rupees general deduction. I hope it is clear to all of you. Last but not least, you have to compute the tax over here. What is the tax rate for cooperative society? Up to 10,000, no tax. Above 10,000, sorry, up to 10,000, 10%. Above 10,000, up to 20,000, 20%, and above 20,000, it is 30%. Now, for cooperative society also, there are new regimes, 115 BAD and 115 BAE, but Institute has not considered this over here because this is an old paper, and at that time, the cooperative society's alternative tax regimes were not introduced. So, therefore, we are not considering that over here, but you can also follow 115 BAD and BAE over here, okay, if you are a resident cooperative society. Now, one last question over here in this particular question, in this particular paper, that is question number 6, part A. There is an assessee, Mr. Mahesh. He received the draft order as per 115, as per 144C. Now, who receives a draft order as per 144C? If you are non-resident, if you are a foreign company, or if there is a TPO who has passed an order which is prejudicial to you and you have got the order which is against you, you can go for what? Dispute resolution panel. You have an option to go for dispute resolution panel. But is it mandatory that I have to go for dispute resolution panel? I did not go for the dispute resolution panel. I want to go for the CIT appeal later on. Can I do so? And the answer is yes. Assessee preferred to file an appeal to CIT appeal instead of going to dispute resolution panel. Therefore, the assessee can do so. The question over here is, can Mr. Mahesh do so? Is the contentions of Mr. Mahesh tenable? Yes, the contentions of Mr. Mahesh are very much tenable. Mr. Mahesh can directly go for what? Mr. Mahesh can directly go for what? CIT appeal instead of routing through what? Dispute resolution panel. Let the assessing officer pass the order, and after that I will go for what? After that I will go for directly to the CIT appeal. And one last question over here. The AO has initiated a penalty proceeding under 270A for and also initiated what? Prosecution under 276C. Now, I am filing an application for immunity from penalty and prosecution. Is the application filed? Is he entitled to file an application? See, if the AO is imposing penalty under 270A and if the AO is imposing prosecution under 276C, you have only one option, that is 270AA. You can go for 270AA. First of all, you have to file an application within 30 days from the date of receipt of what? From the date of you have to file an application within 1 month. Then you have to pay the tax. You have to pay the interest. You cannot file an appeal against the assessment order. And then AO will pass the final order. And then there is one very important thing, that the AO will only waive your penalty, which is 50% penalty. He will not waive your 200% penalty. In this case, only 50% penalty is waived, 200% penalty is not waived, not waived, not waived. I hope it is clear to all of you. This is what this first paper is all about. So let's move on to the next paper, that is July 2021. The very first question over here is on total income of a company. Let's see the last line, what exactly they are asking. They have asked total income, and we are not supposed to follow MAT. We are not supposed to follow 115BAA also. We are just supposed to compute the total income. We are not supposed to compute even tax in this question. Just compute total income as per the normal provision. Okay. So now the very first thing over here, the assessee is engaged in manufacturing business. Therefore, you need to be very careful whenever the word manufacturing comes in the exam. Okay. So the profit of the assessee is 1,000 lakhs. The very first adjustment is depreciation as per the books of account. Therefore, you have to add back that depreciation. The second adjustment is the assessee has paid 50 lakh rupees for a scientific research. It is a donation for scientific research institution. So the assessee will get deduction under section 35 subsection 1 clause 2. Now when one very important line which is given in the last line in point number F, that after the assessee has given the donation, subsequently the approval is withdrawn by the central government. So will that affect my deduction? The answer is no. There is a specific provision in the law which says that when you make the payment of donation, at that time the approval is there, and if subsequently the approval is withdrawn by the central government, your deduction will not be denied. It will be allowed to you. Don't worry about it. Okay. So there will be no effect on your deduction. Okay. Now the next one is you have taken a loan of 350 lakhs. This similar adjustment we have already done under RTP also. But again, I will say you have taken a loan of 350 lakhs on 1st of May 2023 for purchase of machinery. So if you have taken the loan on 1st of May 2023 for machinery, it means you have taken a loan for, you have paid interest for 11 months. Okay. So if I take the interest of 11 months, it comes to 350 lakhs into 8% into 11 by 12. It will come to 25.67 lakhs. Okay. This is the total interest that the assessee has to pay in the current year. This is the total accrued interest. But has the assessee paid? The assessee has paid the interest on 1st of November 2024. That is after the due date of filing of return. Now we need to identify where the company has used this particular loan. This company has used to purchase a machinery. Out of that, how much is used to purchase a machinery? Pay attention over here, please. The machinery is purchase of 500 lakhs and it is put to use on 1st of Feb 2024. So from 1st of May till 31st of Jan, you can say that much interest will be capitalized to the cost of asset, right? So how many months interest will be capitalized to the cost of asset? Because till the time the asset is not put to use, you have to capitalize the interest to the cost of asset. So 9 months interest. So out of this 25.67 lakhs, this is 11th month interest. So 9-month interest will be added to the cost of asset, and 2-month interest should be allowed as a revenue expense. So I am telling you the ultimate treatment. What is the ultimate treatment? This 9-month interest, first of all, will be added to PGBP. It is not allowed as a deduction, and you have to add that to the cost of asset and claim normal and additional depreciation. What about the 2-month interest? 2-month interest also you have to add back to PGBP, and you cannot get the revenue expense deduction over here as per 43B because you are making the payment after the due date of filing of return. You cannot claim this deduction also under the income tax law. Okay. Sir, for this also, sir, capitalization is allowed if it is not paid. Yes, I have told you earlier also, for capitalization, there is no need to make the payment on time. For only taking that as a revenue expense, you need to make the payment on time. Okay. So for capitalization, there is no need to take the no need to make the payment before the due date of filing of return. You can capitalize even without that. Next one, you have paid some salary of 100 lakh rupees to foreign technician for installation of machinery without deduction of TDS. No harm. Add that to net profit. You have to add that to PGBP and add to the machinery and claim depreciation. For claiming depreciation, there is no need to deduct TDS. If you want to claim that as a revenue expense, then there is a need to deduct TDS and pay TDS. Okay. You need to be very careful about it. Now, so this 100 lakhs will also be added to the cost of machinery. Now, then you have paid some 35 lakhs rupees as a general expense towards bringing some water to the factory. So that is a very normal thing. Without bringing the water to the factory, how can you run the factory? Therefore, it will be allowed as a revenue expense under section 37(1). There is no harm in that. Okay. Next, you are giving some donation to a political party. It will be disallowed under PGBP, and under 80 GGB chapter 6A, you can claim that as a reduction. You have to write a note that we are assuming that it is other than cash, because if it is in cash, then it is not allowed as a deduction. I hope it is clear. Next one, the SSC has incurred some expenditure of 25 lakhs towards purchase of coal, but unfortunately, the SSC does not have a direct evidence of invoice available against that purchase. But SSC has indirect evidences like GIR is there, goods inward report. The SSC has payment details. The SSC has other details. Auditors have also made a remark that in this particular case, whether this expenditure will be allowed or not. Now, it depends upon the views of the assessing officer. ICAI has taken both the views. If the assessing officer is satisfied with you, he will allow you. If the assessing officer is not satisfied with your evidences, he will disallow the expense. ICAI has taken both the views in this particular question, so be very careful about it. Next adjustment also, similar adjustment we have done earlier in RTP also. Let me tell you what is happening. First of all, you are making a sale of 20 lakh rupees to a person, and then 10 lakhs rupees you are writing it off. So you are making a sale of 20 lakhs, I am crediting to the PNL, and then 10 lakhs you are writing it off, I am debiting to the PNL. Okay. Now the debtor is now dead. He has demised. He has expired. So you are able to collect only 7 lakh rupees now. Now after you collected the 7 lakh, you have what? Credited that 7 lakh to the PNL. First of all, why the hell you have credited that 7 lakh to the PNL? You have already credited 20 lakh to the PNL earlier. You are getting 7 lakh out of that only now. So you have to reduce that 7 lakh first of all. It's very clear. See, it's very common sense. You have credited 20 lakh rupees sales earlier. 10 lakh is not receivable. So you have written it off. Now 10 lakh, remaining 10 lakh is receivable. Now the person is dead. You received only 7 lakh. So why will you again credit that to PNL? That 10 lakh is, that 7 lakh is also credited in the PNL in the form of 20 lakh. So reduce that 7 lakh first of all. Then reduce further 3 lakhs because 3 lakhs has become your actual bad debts out of the balance 10 lakhs. 10 lakh is receivable. Okay. Out of that 3 lakh, you have received only 7 lakh. So 3 lakh has become actually bad. So that much also you should be reducing from the PNL account. Okay. Next, some written down value of the assets are given at the beginning of the year. For building, you will take 10% depreciation. For computer, you will take 40%. For office appliance, you will take 15%. For tractors, see very carefully, it's an important point. Tractors which are used within the factory. These tractors are used within the factory. There is some importance in this in the subsequent line. You will take 15% as it is a plant and machinery. Plant and machinery, you will take 15% depreciation. Okay. Now you have made some additions during the year. So accordingly, you see when you have made the addition, are you using for more than 180 days or less than 180 days? Factory building, you are putting to use on 1st November, therefore only 5% less than 180 days. Computer, 1st May, full depreciation. 40% depreciation you can claim. Now tractor, 15 lakh tractor you have purchased on 1st of August. What kind of tractor it is? It is used inside the factory. So if a tractor is used inside the factory, it is not used on the road. It is not used on commercial road. It is used inside the factory. So it is like a forklift trucks. And remember, in this case, you will get normal depreciation also and additional depreciation also. Do you remember that? A forklift trucks is a specially designed vehicle which runs inside the factory, that is eligible for what? Additional depreciation. Therefore, this tractor is also eligible for what? This tractor is also eligible for additional depreciation under the income tax law. So 15% normal depreciation, 20% additional depreciation you are going to claim. Another tractor you have purchased on 1st of Feb 2024. So if you have purchased for less than 180 days, put to use for less than 180 days. On this case, you will get 7.5% normal depreciation and 10% additional depreciation. Okay. Then machinery, 500 lakh is the cost. Then apart from that, 100 lakhs foreign technician salary you have to add back, and 21 lakh you have to add the interest. And on that machinery, you are going to claim what? 50% depreciation, that is 7.5% because it is put to use again in Feb 2024. So 7.5% depreciation and 10% additional depreciation also you are going to claim on that particular machinery. Okay. Last but not least, expenditure is incurred on ISO 9000 certificate rupees 10 lakhs. So the CBDT has said that it is not treated as an intangible asset. Treat it as what? Treat it as a revenue expense. Remember, whatever is the additional information now, that is not debited or credited to P&L. Only these items are debited and credited to P&L. So accordingly, you have to give the effect in the examination. You have to be very careful with that. Okay. Now let's move on to the next question. Question number 2. In question number 2, there are multiple parts. The first part has become redundant. That's the reason. Just strike it off. It is not relevant in today's time because this is based on some section which has now become outdated. It is based on section 170, old section. Now a new section 170 has come. You can go and check the chapter of miscellaneous amendments in our color book number 2. Last chapters are there. You will see over there a new 270A absolutely in green color made by Finance Act 2023. Therefore, this question will become redundant now. So don't focus on this question. Now, the second question is a very good question. There are 3 views taken over here in this question. What is the first view? There is an assessee who has filed the return, and after the return was filed, his case was selected for scrutiny by the assessing officer. And the assessing officer is saying 3 things. First, the assessing officer is disallowing 50 lakh rupees and saying that you cannot prove the bad debts, therefore I am disallowing the bad debts. Now the question is the assessing officer correct? Am I supposed to prove to the assessing officer that my debt has become bad? And the answer is no. It is not necessary to prove that the debt has become bad. I used to say in the class also, there is a provision in the law which says that it is not necessary to establish that the debt has become bad. You need to just write it off in the books of accounts and that's it. You can claim the deduction. Therefore, the assessing officer is wrong in this case. You don't have to prove that the debt has become bad. Okay. You have to just write it off in the books of account. The second thing which the assessing officer has done, he has disallowed some repairs and maintenance on the ground that I have booked the repairs and maintenance on an estimated basis. Okay. So why is he disallowing? He is disallowing because he is saying that I have claimed the repairs and maintenance on the basis of what? Estimation. So can the AO disallow the repairs and maintenance on the basis of estimation? Again, it depends upon AO's view. If it is a current repair, you have to prove it to the assessing officer that this expenditure of repair and maintenance is a current repair, it's a current year repair, it's a revenue repair, it's a current year repair. Therefore, you have to prove it to the assessing officer it is a current repair, he will allow you. But if you are not able to prove to the assessing officer that it is a current repair, that he will not allow you the deduction of that particular repair and maintenance under the income tax law. Okay. So it depends upon whether you are able to prove it or not. Okay. And the third one and the last one, this partnership firm AN company, in this there is another partnership firm who is becoming a partner in this partnership firm. So a partnership firm has one of the partner as a partner in the partnership firm. So therefore, the AO said that it is not a legal entity. Therefore, the AO changed the status of the partnership firm to AOPBY. I am a partnership firm and another partnership firm is a partner in my firm. So the AO said that this is not possible. Therefore, I am changing the status of the firm as what? AOPBY. Is the contention of the assessing officer correct? And the answer is yes. The court has said that yes. Why, sir? Why? A partnership firm cannot become a partner in a firm. No, a partnership firm cannot become a partner in a firm. Sir, why? Who can become a partner in a firm? Only a person who is a legal person can become a partner in a firm. Individual is a legal person. Company is a legal person. These are legal persons as per the law. Therefore, these people can become partner in a partnership firm. As per Indian law and even as per the global laws, many countries' law, partnership firm is not considered to be a legal person. Therefore, if you are not a legal person only, how can you become a partner in a partnership firm? Moral of the story is very simple, that a partnership firm cannot become a partner in a partnership firm. If it becomes a partner in a partnership firm, then that partnership firm will be treated as a association of person by the assessing officer, and the assessing officer is correct in this particular case. Okay. Now, let's move on to the next question. This is a beautiful question on DTAA, and out of the world question on DTAA. Altogether a different type of question when it came for the very first time. The students were not able to understand what exactly the ICI wants to ask over here. Now, let me brief it up exactly what is happening over here. There is one person, Mr. Ram, a citizen of USA. He used to stay in San Jose in USA since 2007 and is a non-resident since 2007-8. Now, he works for a foreign company, XINC, a US-based company. Now, he came to India on 10th of Jan 2023 to visit his aged parents. Okay. Now, he could return back from India only on 31st of Jan 2024. So, he came on 10 Jan 2023 and he returned back on 31st of Jan 2024 from India. Okay. Now, he was permitted to work from home in India. So, when he came to India, he was working in India on behalf of his employer. Okay. So, this is a very important detail which is there in front of us. Now, then you have the monthly salary which is there in front of us. Then he has earned some fixed deposit in USA, etc. Blah, 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 blah. We are supposed to follow 115 BSc subsection 1A. That is the new regime. And we are also supposed to find out the foreign tax credit. Now, we need to go very slowly in this particular question. We need to go step by step. The very first thing that I would like to find out is the residential status of Mr. Ram. Mr. Ram is staying in India for how many days? Now, he came to India on 10th Jan 2023 and he returned back on 31st of Jan. So, if I count his number of days in the current year 23-24, from 1st April to 31st Jan 2024, he was in India. So, from 1st April to 31st Jan, if I count, it comes to 306 days. So, therefore, he is definitely a resident. He is a resident. But is he an ordinary resident? The answer is no. Why is not an ordinary resident? Because his stay in India for the last 7 years is not 730 days. It is less than 730 days and he is not resident in last 2 years after the last 10 years. He is not fulfilling the additional condition. Therefore, he is not ordinary resident. Now, which incomes of a not ordinary residents are taxable in India? If you are a resident but not ordinary resident, which incomes are taxable? Income has to be either accrued in India or deemed to accrue in India or receive in India or deemed to receive in India. Only these incomes are taxable. And if there is a PGBP outside India and if it is controlled from India or if there is a profession outside India but it is set up in India, only these incomes are taxable. Otherwise, if an income is accrued outside India and received outside India, that income is not taxable in the hands of not ordinary resident. Now, he is earning some salary. He is in India and he is working from home in India. Is that salary income accrued in India? The answer is yes. Because he is working in India, because he is rendering services in India, therefore the salary is deemed to accrue or rise in India, therefore it is taxable. So from which month you will take? You will take from April to Jan month, salary will be taxable in India. Now the salary fortunately is same in every month, $6250. Now you need to convert that into INR. How will you convert that into INR? You have to convert that into INR as per Rule 115. You have to apply Rule 115 to convert that into INR. What does Rule 115 says to convert salary? You have to take TTBR of the last day of the preceding month. So for April, you will take TTBR of March. For May, you will take TTBR of April. For June, you will take TTBR of May. But fortunately, what is happening over here? The salary of all the month is same and the TTBR also of all the month is same. So I can directly do one thing, that is 6,250 into 10 months from April to Jan. It is how many months? It is 10 months into 72. If I directly do this, I will get the salary of this particular person. Okay. So that is the salary of this person is 6250 into 72 into 10 months. That comes to 45 lakhs in rupees. Okay. Now, will I get standard deduction? Yes. Even in 115 BSc from Finance Act 2023, you get standard deduction. Therefore, my salary will be 44,50,000 rupees. I hope it is clear to all of you. Now, apart from that, is he earning any other income? Yes, he is earning some fixed deposit in USA. Will that be accrued in India? The answer is no, because it is accrued outside India. It is received outside India and the SSC is not ordinary resident. Therefore, for him, this income will not be taxable. Okay. Now, after that, I am going to apply what? The slab rates as per the new regime. So, this interest will not be taxable. Then I will apply the new regime and I will compute the tax and the tax is coming to 10,76,400 rupees. Okay. Now, be very careful. Now, the real game starts. Now, he is paying some taxes outside India also. As per Article 2 of DTAA, the taxes covered for credit are federal income tax imposed by the Internal Revenue Code. What is Internal Revenue Code? That is the taxation law of United States, but excluding Social Security tax. So he will get the FTC. He will get the foreign tax credit of what? Foreign tax credit of federal tax. But he will not get the foreign tax credit of Social Security tax. Okay. So he will get the credit of this. He will not get the credit of this amount. Now there are two assumptions which are made by the institute. ICI has made two assumptions. Assumption number one is this include this tax If this include this tax also, you have to reduce this from this particular column. Okay. And second assumption which ICI has made, this federal tax does not include social security tax. If it does not include social security tax, then 1600 is the amount of which you are going to get the credit. Okay. But if this includes social security tax also, then you have to reduce this 420 rupees every month from your total tax. Okay. Because the law is only, Article 2 is only giving you the credit of for federal tax excluding social security tax. Okay. Now, how much credit is available? Whatever is the tax in India and whatever is the foreign tax, whichever is lower, that much credit is available as per Rule 128, as per the income tax law. Now listen carefully. Let's make first assumption. Assuming that, let's make the first assumption that social security tax is not included in the federal tax. If it is not included in the federal tax, then it will come to 1600. The entire federal tax will be federal tax only. There is no social security tax into 10 months into 72. That will come to 1152. Okay. And how much tax he has paid in India? He has paid tax of 10,76,400. Therefore, whichever is lower, how much FTC will be available? He will be available with 10,76,400 FTC. In second case, it is 1600 minus what? Minus 420. Minus 420. Why? Because here we are making the assumption that SST, social security tax, is included in the federal tax. So that much we have to reduce it. Okay. So that much we are reducing. So 1600 minus 420, 1180 into 10 months into 72. How you are taking 72, sir? That is as per Rule 128. If I want to convert my foreign tax into Indian tax, then I have to take TTBR of the last day of the preceding month. That's what I am doing. Fortunately, here every month's TTBR is same only. So there is no problem over here. If the TTBR would have been changed in every month, then I would have to take different TTBR for different months. Okay. So accordingly, here my FTC comes to 849. Therefore, if my FTC is 849, my total tax is 1076. I have to pay some amount, that is 2,26,800 from my pocket. In first case, there is no tax payable because my FTC is more than my tax. Okay. Therefore, there is no tax payable. Therefore, in the first case, even if I file the late return, no interest will be payable under 234A. But in the second case, if I am filing a late return, there is a tax payable of 226,800. Therefore, I am supposed to pay interest at the rate of 1%. If I am filing the return in August, I am supposed to file in July. I am filing in August. I have to pay interest at the rate of 1% for 1 month. Okay. So this is what this dangerous question is all about. One last thing over here is, we need to also say some procedure that you need to fill one form 67, and you need to just change it. There is a due date of this is changed. Earlier it was by the due date of filing of return. Now it is before the end of the relevant day in which the income is offered. So you can file this till 31st of March 2025. You need to file a statement in form 67 if you want to take the FTC. Without filing the statement, you are not going to get the deduction of FTC. Okay. So just change this date. This is not changed. This is the old date. There is an amendment made by last Finance Act. We need to change this in our book. Okay. So just change that. Now let's move on to question number 3 now. There is an investment fund, and it has 20 resident unit holders. How many resident unit holders? 20. All of them are holding 5 units each. So therefore total 100 units are there, out of which 16 unit holders are holding for more than 12 months. So out of 20, if 16 unit holders are holding for more than 12 months, it means 80% unit holders are holding for more than 12 months and 20% unit holders are holding for less than 12 months. What is the importance of this? You will come to know in a while. Okay. Now, the very first thing, we need to identify what income is taxable in whose hands. How much income is taxable in the hands of fund and how much income is taxable in the hands of the unit holder. We need to answer that. First of all, business income is taxable in the hands of the fund and investor is not liable to pay tax. For investor, it is exempt under section 10. Okay. Second, long-term capital loss. Long-term capital loss, first of all, it has to set off against fund's income. But there is no income against which the fund can set off. Fund cannot set off long-term capital loss against PGBP or IFO's income. Long-term capital loss can set off only against long-term capital gains. So if that is not possible, then you can attribute that to the investor, but only to those investors who have been more than 12 months older. So how many investors are more than 12 months older? 80% investors are older than 12 months. Therefore, 80% of 30 lakhs will come to how much? 24 lakhs. Therefore, 24 lakhs you can pass on to the investors and remaining 6 lakhs the fund can keep it with itself. Okay. So 24 lakhs the investors will set off against their LTCG and the remaining 6 lakhs the fund will set off against their LTCG in future years. Okay. Third one, other sources who will pay tax. Other sources also, fund investor will pay tax, fund will not pay tax. So this 40 lakhs rupees will be passed on to the investors. Okay. Every investor will get this 40 lakhs and this 40 lakhs investor will pay the tax. Last question, what would be your implication? Will your answer change? If the fund distributes only 80% and not 100%, it doesn't matter. In case of investment fund, whatever is earned by the fund, that has to be taxable in the hands of the investor. It doesn't matter how much is distributed. Even if 80% is distributed, the investor has to pay tax on the entire 100%. I hope it is clear to all of you. Okay. Now the next question is a routine question. We have done a similar question earlier also, but still I would repeat it once again. Henceforth, if a similar question come, I am not going to repeat. There is a non-resident German company First of all, this is earning some dividend from an Indian company, therefore it is taxable at 20% as per 1158. Second, this non-resident is providing some technical know-how, and in return the Indian company is giving debentures, not money. The Indian company is giving what? Debentures rather than what? Money. Therefore, this particular thing will be taxable under income tax law in the hands of the foreign company, and it will be taxable at how much rate? It will be taxable at 40%. Why? Because there is no agreement between both of them which is approved by central government. If you want to tax under 115A, there has to be an agreement between both the party, and it has to be taxed. It has to be approved by the central government. There is no agreement which is approved by. Further, because the debentures are issued, interest on debentures will also be taxable in the hands of the foreign company, and it will be also taxable at 40%. Why 40%, sir? Why not 115A? Because in Indian currency, it is not in foreign currency. Because it is in Indian currency, that will also be taxable at 40% only. Third case, the foreign company is receiving some dividend of 5,50,000 on GDR. So this will be also taxable in the hands of the foreign company. But remember, it will be taxable at 115 AC at the rate of 10%. But you have to gross it up. Why gross it up? Because the word used over here is received. Foreign company has received 5,50,000. So if they have received 5,50,000, it has to be after the TDS only. Therefore, you have to say that if the tax rate is 10.4%, and if it is received 5,50,000, therefore 5,50,000 is what? It is 89.6%. Therefore 100 is how much? You have to cross it up and write down the grossed up income. Okay. Next one, business income will be taxable at 40%, and royalty, there is an agreement. It is not covered in 44DA. There is an agreement which is approved by central government. So this will come in 115A. Again, it is received. DTSAA says that royalty is taxable at 24%. Therefore, you will tax the royalty at 20% because as per 115A, it is DTAA or 115A 20% rate, whichever is lower. Therefore, 20% tax will be at 20.8. Again, you have to gross it up. If it is 20.8, then you have to gross it up at 79.2%. If 10 lakh is 79.2%, then 100 is how much? Gross it up and tax it. Okay. So this is what a similar question we have already done earlier. I don't think so. This is now very difficult for you all. Question number 4, which is on TDS. There is an infrastructure debt fund who are making some payment to some foreign company. How much TDS they will deduct? They will deduct TDS at the rate of 5% plus 4% says 5.2% under section 194 LB. If an infrastructure debt fund pays interest to a foreign company or non-resident, it will deduct TDS at the rate of 5%. What about if that foreign company or non-resident is located in NJA? If that foreign company or non-resident is located in NJA, then it is taxable at, then the TDS will be deductible at 30% plus 4% says, that is 31.2%. Okay. Further, no deduction of any expenses will be allowed out of the income. It is directly taxable at 5% or 30% as the case may be. If normal case 5%, in NJ case it is what? It is 30%. I hope it is clear to all of you. The next is a very simple adjustment, that is whether TDS is applicable on retention of commission. If a commission is retained by any person, if a consignee is retaining a commission, whether TDS is applicable in that case also, and the answer is yes, 194H is applicable in that case also, where the commission is retained by the consignee. I hope it is clear to all of you. The third one is a very, very good point. Mr. Harsh is an employee. He has joined the company in 2020, and in 2024 he is leaving the company. So he is retiring in the company. He is retiring from the company within 4 years. So remember, if you retire from the company, if you leave the company within 5 years, and if you withdraw any money from PF, then that is taxable. And if you withdraw more than or equal to 50,000 rupees, then even TDS will be deducted under 192A. So how much TDS will be deducted? 10% TDS will be deducted because you are retiring within 5 years and the amount paid to you is greater than equal to 50,000 rupees. Therefore, 10% TDS will be deducted under 194A. What would be your answer? His PAN is available. What would be your answer if his PAN is not available? If his PAN is not available, then you will deduct 20%. Earlier it was MMR, but Finance Act 2023 has made an amendment that in such cases it will be taxable at how much? It will be taxable at 20% only. Don't deduct at MMR, please. Okay. Now, the next person is Mr. Money, has purchased a flat of 48 lakh rupees. Apart from 48 lakh rupees, he is paying some maintenance charges of 5,000 per month for 2 years. So that amounts to what? 1,20,000 rupees. Further, he has paid some advance of 2 lakh rupees for car parking, 1 lakh for club membership. What would be, whether the TDS will be deducted in this case or not? If yes, how? Yes, TDS will be deducted. You have to see all the charges inclusive. If it is 50 lakhs or more, then TDS is deducted at the rate of 1% on the consideration or stamp duty value, whichever is higher. In this case question, if I sum up all the charges, it is greater than 50 lakh rupees. So if it is 50 lakhs or more, TDS has to be deducted in this case. Okay. Therefore, in this case, TDS is deducted. If stamp duty value would have been given, then TDS would have been deducted at higher of the two. Okay. In this question, stamp duty value is not given, so ignore that. Okay. One last question in this particular paper, that is Paras Limited is an Indian company and it is a manufacturing company and it has taken a loan of 60 crore rupees. Okay. Now, Saksham is a German company and it has purchased from Paras. Paras is selling to Saksham some goods of 2,000 rupees per unit. To other dealers, Paras sell at 2,100. But to Saksham, Paras sell at 2,000 rupees. Okay. Now, both of them are what? Associate enterprise. How did you come to know that both of them are associate enterprise? Because Paras has taken a loan of 60 crore rupees, out of which Saksham has given 9 crore guarantee. So if one entity gives guarantee to the other entity of loan of 10% or more, then both of them are deemed to be associate enterprise. Do you remember that or not? If one entity gives 10% guarantee of the loan to another entity, then both of them are deemed to be associate enterprise. Now it's a very simple question. See, I am Paras, I am selling goods to my associate enterprise at how much? At 2000. To others I am selling at 2100. Now it is very simple. To others, to Saksham I am giving a credit of 3 months, whereas to others I am giving a credit of 1 month. Okay, so it's a very simple question, nothing great as such. First of all, what is the unrelated price? You need to follow cup method over here. Cup method, what is first step? Price at which you sell to other person. To other person you are selling at how much? 2100. Okay, 2100 is the price at which you are selling to other person. Now what is the functional difference between both of them? See, to others you are giving a credit of how much? 1 month. But to Saksham you are giving a credit of 3 months. Therefore you are giving 2 months extra credit to Saksham, and the cost of credit, cost of capital is 12%. So 2 months extra cost you will add to Saksham. Okay, therefore 2100 into 12% into 2 by 12, that extra cost you have to recover from the Saksham, na? Because to Saksham you are giving 2 months extra credit. So for 2 months extra credit you will recover extra cost or not? So that extra cost has to be added over here. If I add that, my arm's length price comes to 2142. Okay, after that I will multiply by 5 lakh unit, I will get the arm's length price. Okay, and this is the amount which has to be adjusted to the what? Arm's length price. I hope it is clear to all of you. Now listen carefully please. There are a lot of questions which are asked over here. Are Paras and Saksham associate enterprise? Yes, associate enterprise because of what? 10% guarantee. What you need to compute the arm's length price. Arm's length price is very simple. 2100 plus 2 months extra cost of capital I have to add back, that is arm's length price. Okay, and then you have to multiply by 5 lakh units, that will give you the amount to be added back to the total income. Okay, now if these adjustments are made suo moto by Paras, okay, what is the time limit to repatriate the money? It's a very simple question. You have to repatriate that money back to India within 90 days on the due date of filing of return. If you don't repatriate that money within 90 days on the due date of filing of return, on that much amount will be called as deemed income, deemed loan. A secondary adjustment will be applied on that much amount, and you have to take SBI's MCLR plus 3.25% as on 1st April 2024, and whatever is the interest that has to be added back over here, including the 90 days period. Interest will be counted from 1st December only, including the 90 days period till 31st March. Whatever the interest will be added back. Another option is there with the law says that if you pay one-time additional tax at the rate of 18% tax, 12% surcharge and 4% cess, and then you will be relieved from your secondary adjustment from the next day onwards. Okay, so this is the second option which is given in the answer also. You can check it once, and this is what this paper is all about. Now let's move ahead with the next paper, that is December 2021. Now one thing you might be thinking that why the attempts are so strange. Jan 21, July 21, December 2021. That is all because of COVID. During that time COVID was there, and therefore ICAI was taking exams whenever it was possible for them to take the exams. Okay, so that's the reason the attempts are very strange in this particular case, in that financial year, especially in that calendar year 2021. Now let's move ahead with the first question over here. The first question over here is of total income. Assessee is a manufacturing assessee, and we are supposed to solve this question as per 115 BAB. Okay, 115 BAB we have to solve this question as per, and we have to not consider MAT. Obviously, if the assessee follows 115 BAB, then MAT is not applicable. So let us start with the question. The very first thing over here is manufacturing company. So accordingly, you have to react over there, and then there is a leather product. Whenever there is a leather product or an apparel business or a footwear business in the question, then there can be an implication of 80 JJAA, where you need to employ the employee only for 150 days, not for 240 days. Remember that generally if you want 80 JJAA, you have to employ the employee for 240 days, but in these three businesses you have to employ only for 150 days. So that is a very important factor over here. Now the profit is 1 crore 20 lakh rupees. The very first adjustment over here is the assessee has made some mistake in the penal account. They have what? They have overvalued the opening stock by 10%, and they have undervalued the closing stock by 10%. Overvalued the opening stock means they have taken more deduction. Undervalued the closing stock means they have shown less profit. Okay, therefore if they have overvalued the closing stock and the closing stock is 55 lakhs, it means closing stock is 110%. So do backward calculation and add the differential amount. Okay, similarly for closing stock, it is undervalued. It means closing stock is 90%. It is not 110% because it is undervalued by 10%. Therefore 54 lakhs divided by 90%, add back that much closing stock profit to the P&L account. Okay, so undervalued overvaluation of closing stock will also be added back, and undervaluation of closing stock, overvaluation of opening stock will also be added back, and undervaluation of closing stock will also be added back to the profit. Okay, next one, you are making some payment of 10 lakh rupees as sales commission to a foreign agent who is procuring orders from outside India, are you liable to deduct TDS in such case? The answer is no. If an agent is outside India and is procuring orders outside India, then the income of the agent is accrued or deemed to accrue outside India. Then there is no question of deducting TDS, okay? And if there is no question of deducting TDS, why the hell the expenditure will be disallowed my case? Therefore, in this case, there will not be any disallowance to you, okay? Don't worry about it. Next, you have paid 45,000 rupees in cash to one of your employees at the time of retirement. Will you disallow that because it is more than 10,000 rupees? The answer is no. In Rule 6DD, it is very clearly written that if you can, Rule 6DD, which is an exception of 48.3, it is very clearly written over there that if you make a payment to an employee on retirement, like gratuity, like PF, like pension, like you can say VRS, etc., retrenchment compensation. If you make the payment on retirement, you can make the payment up to 50,000 in cash. So the limit has been increased for retirement payment up to 50,000 in cash. Therefore, 45,000 is allowed. Okay. Next one, 31st Jan 2018. Whenever 31st Jan 2018 will come, you will apply grandfathering clause. I'm not speaking much on grandfathering clause. I have spoken sufficient earlier also on grandfathering clause, how to determine the cost in case of grandfathering clause. Okay. Next one, you are deriving some STCG from a capital asset which is non-depreciable capital asset. Maybe it is a land. Okay. So reduce from PGPP, show under capital gains, and while charging the tax, you will be charging this at 22%. Why 22%? Because it is taxed at general rate. Okay. If it was a part of block, if it would have been a depreciable asset, short-term capital gains, I would have charged 15% as per 115 BAB. You have to remember the rates of 115 BAB. There are multiple rates in 115 BAB. Next is a very routine adjustment. You are selling some land, etc., to your 100% holding subsidiary, and the recipient is an Indian company. So then in that case, it is exempt under income tax law under section 47. So reduce from here and show exempt under section 47. So nothing great as such. Next is a very beautiful adjustment. You are receiving some dividend of 50,000 rupees from a domestic company. Now remember, you will reduce this from PGPP. That is a very simple adjustment. Dividend is covered under IFOs. So reduce from PGPP, but when you go to IFOS, you have to gross it up. Why, sir? Why gross it up? Because it is received, it is dividend received. It means it would have been received after net of TDS under section 194, and under section 194 TDS of residents are deducted at 10%. Therefore 50,000 is 90%, so 100% is how much? 55,555. So this is a very, very important adjustment that you have to keep it in your mind. Next one, you are making some payment of 20,000 rupees for inauguration of new branch, obviously for expanding the business. That is nothing but it is for business, it is for business and profession. Therefore it shall be allowed as a business expense. There is nothing wrong in that. Okay. Next one, you are making some payment of penalty to government for failure to perform in contract, and there was a delay of 4 months. So it's a compensatory penalty. Compensatory penalty is allowed. Delay in contract is all these things happens in business, and therefore it's a compensatory penalty. It is allowed under the income tax law. A penal penalty is not allowed under the income tax law. Next one, you are making some payment of VRS of 5 lakh rupees. The VRS is allowed under 35 DDA, not directly, but 1/5 in 5 years. Therefore 4/5 you have to disallow in the current year. Okay. Next one, you have taken some deposit from a non-resident. What you have taken? You have taken a deposit from a non-resident and you are using that money in India for manufacturing purpose. Now you are paying interest to that non-resident. Whether that interest will be accrued in India or not? Definitely. If you take a loan from a non-resident and if you use that money in India for business and profession, and when you pay the interest, that is deemed to accrue or rise in India as per section 915. Therefore, you should deduct the TDS. Now you have not deducted the TDS. Therefore, this 75,000 interest will be what? Disallowed under the income tax law. I hope it is clear to all of you. Now, the next adjustment is a very critical one for all of us, and it is a clarificatory adjustment for all of us. So please be careful over here. There are 56 employees which we are hiring. Okay. All of them are contributing to Provident Fund. So now this adjustment pertains to 80JJAA. 80JJAA, which talks about 30% of the additional employee cost will be allowed as deduction. Now, out of the 56 employees, now they have given the bifurcation. 39 employees were hired on 1st June at a salary of 15,000 rupees per month. Will they be covered? Yes, they will be covered, because their emoluments is up to 25,000 rupees and they are hired for more than 150 days. In this question, 150 days is sufficient because the assessee is engaged in leather business. Next. But out of those 9 employees, 9 employees were settled by bearer check. So all those who are settled by bearer check, they will not be allowed deduction under 80JJAA, because in case of an existing company, you cannot make the payment other than the 4 modes. If you are making the payment by bearer check or cash, then it is not allowed under 80JJAA. Therefore, out of 39, 9 employees are out of question. Only 30 employees will be eligible for deduction. So 30 employees into 10 months into 15,000 into 30%, this much will be allowed as deduction. Let's talk about the other employees. 14 employees will not be eligible because their emolument is 45,700. It is more than 25,000. And 3 employees who are joined on 1st of November their emolument is 22,000 rupees, they will be eligible, because if I take from 1st November to 31st March, it is coming to around 151, 152 days. It is greater than 150 days. In this case, 150 days is sufficient. Therefore, these 3 employees also, you will be getting the deduction under 80JJAA. Okay, I hope it is clear. Now coming to very important clarification which I would like to make over here. The very important clarification that I would like to make over here. Sir, 9 employees to whom you are paying the by bearer check, you have not taken 80JJAA. But why the hell, sir, you have not disallowed that under PGBP? Because if you are making the payment by bearer check of more than 10,000 rupees, you have to disallow the salary also under PGBP. Yes, absolutely correct. This is what ICI has not done in its RTP, and ICI has done in its exam paper. And they have given both the views. They have given 2 views, which I feel one is correct, one is incorrect. One view, they have said that 9 employees, whatever salary you are paying, you have to disallow that in 48(3) also under PGBP. Second view, they are saying that this data which is given over here, assume that this is only for 80JJAA. It is only for 80JJAA, and whatever 9 employees salary which is given in cash, that we have already disallowed and given you the revised profit over here of 1 crore 20 lakh rupees. So they have taken both the views. If you have not understood, rewind back and listen once again. So you can do both the thing. You can disallow 9 employees salary, or you can ignore 9 employees salary disallowance, and you can write a note that this might have already been done by the question in the profit. It would have been already given the effect as, and therefore we are not doing anything in that particular case. Okay, I hope it is clear to all of you. And last but not least, the SSC is making a payment of 1,20,000 to National Fund for Rural Development. This deduction is allowable under 35 CCA, and is 35 CCA allowable under 115 BAB? The answer is yes. 35 CCA is not disallowed under 115 BAB. Therefore, you can claim this deduction. And after that, you will compute what? You will compute the tax of the SSC on long-term capital gains of stock market, 1 lakh exempt, balance 10% tax. On 75,000 STCG, 22% tax, as I have told you. On dividend income, also 22% tax. And on manufacturing business income, you will be liable to pay tax at the rate of 15% only. 10% surcharge always imposable under 115 BAB, and 4% cess. I hope it is clear to all of you. Let's move on to question number 2. A subpart 1. There is one company, CMA Impex Limited. This is an amalgamating company, and there is another company, Delhi Impex Limited, which is an amalgamated company. Now, Delhi company is taking over this company, and this company is bringing all these losses. So, which all losses will be given to the amalgamated company? That's what we are supposed to see, and we are supposed to compute the total income of the amalgamated company. Okay. Now, the profit of the amalgamated company is 175 lakhs. It is before setting off the losses. The profit of the amalgamated company is 175 lakhs. It is before setting off these losses, but it is after providing depreciation at the rate of 15% on 160 lakhs. Now, we'll talk about depreciation sometime later. Let's talk about the losses first of all. Which all losses will be allowed out of 175 lakhs? Out of 175 lakhs, the very first loss is speculative loss. Is speculative loss allowed to carry forward and set off under section 72A? The answer is no. Remember, under section 72A, only a business loss which is non-speculation loss under section 72 can be carried forward, and only unabsorbed depreciation can be carried forward. Nothing else can be carried forward. Okay. And apart from that, whatever is related to unabsorbed depreciation, like unabsorbed capital expenditure of family planning, like unabsorbed capital expenditure of scientific research, which is related to unabsorbed depreciation, all of them can be carried forward. Therefore, speculative loss not allowed. Unabsorbed depreciation, yes, you can carry forward and set off that. Therefore, I am reducing that. Unabsorbed capital expenditure of scientific research, yes, you can carry forward that and set off that. Therefore, I am setting off that also 2 lakh rupees. Okay. Then business loss, yes, that is also allowed. I am setting off that also. Now, we are also taking some assets from the amalgamating company. What is the worth of the assets? The worth of the assets is 160 lakhs. Okay. This is the value at which we have taken. But this is not the value at which we depreciate. As per explanation 7 to section 43(1), you have to depreciate at WDV of the amalgamating company. Therefore, I have done it wrong. I have depreciated. I have made this mistake of depreciating the asset at the original value. So, therefore, 160 lakhs into 15%, which will come to 24 lakhs. I have depreciated 24 lakhs, which is wrong. So, I am adding 24 lakhs back, and I am depreciating the correct value. That is, the WDV of the asset is 100 lakh. So, I am depreciating at 100 lakh. Check it, please. And therefore, my total income and profit will come to 39 lakh rupees. I hope it is clear to all of you. Now, next question number 2, which is a question on capital gains compulsory acquisition. The government has compulsorily acquired your land in April 2019. Therefore, you will compute the indexation till April 2019, and you will also compute your period of holding to determine whether the asset is long term or short term till April 2019. Okay. You have received the compensation in June 2020. Therefore, capital gains will be chargeable in the year June 2020. But indexation will be taken till April 2019. Be very careful. Okay. Now, the land was acquired in 2003 for 12 lakh rupees, and you have also incurred some expenses of 30,000 rupees to sell the land. Okay. Therefore, it is very simple. Your sale consideration is 20 lakhs minus 30,000 is your expenses on transfer, and then minus your index cost of acquisition. You will take indexation of which year? 1920, the year in which it was compulsorily acquired, divided by year in which it was purchased. Okay. If you do this, you will get a loss. Now, you will get a loss. That will be a long-term capital loss. Now, after some time, you also received 18 lakh rupees as an additional compensation. This is also taxable. To earn this additional compensation, you have incurred some expenses of 1 lakh rupees. So, you can reduce that 1 lakh rupees, and there is 17 lakh rupees capital gains in your hands. Now, the loss At the time of original capital gains, whatever was the loss, you can set off that loss for 8 years against the what? Enhanced compensation, and you can set off that loss. There is no harm in that. Okay. Now the next question is on transfer pricing, and this question is on transactional net margin method. In transactional net margin method, what happens? You know, in transactional net margin method, you need to find out the net profit margin. And what is the net profit margin? The net profit margin of your transaction with associate enterprise and of unrelated transaction also, of uncontrolled transaction also. Now what is net profit margin? Net profit margin is nothing but net profit upon relevant base. Now what is that relevant base? That can be sales, that can be cost, depending upon the factor. I have told you, I have given you hint in the class. When you sell something, when you export something, then you have to take in the denominator cost, and when you import something, then you have to take in the denominator sales. Okay. When you sell, you take cost. When you purchase, you take sales. Okay. You have to be very careful with that. First of all, we need to see whether the two associates are associate enterprise or not. We need to check that first of all. Alpha Inc. is a foreign company and Alpha Limited is an Indian company, and one entity has given a loan of 1,50,000 Singapore dollar to another entity, and the another entity has a book value of assets of 120 lakhs. Now this is rupees, this is dollar, so let's convert the dollar also into rupees. That is $1,50,000 into 55 rupees per rate is the dollar. Therefore that comes to 82.5 lakhs. Therefore one entity is giving a loan of 82.5 lakhs to another entity who is having a book value of assets of 120 lakhs. Therefore this amounts to 68.75%. Therefore both of them are deemed to be associate enterprise. Okay, there is no harm, there is no question about being a associate enterprise. Therefore this transaction is an international transaction. Transfer pricing is applicable. Now what is Alpha Limited doing? Alpha Limited is selling, it is exporting, it is providing software. Okay. Now therefore the profit margin should be computed as follows. Net profit, because we are selling, we are providing services, therefore the denominator has to be cost. Therefore I will take the net profit margin as net profit upon cost. So what is the net profit margin with respect to associate enterprise? It is how much? I am selling at how much? I am selling at 85, my cost is 80, therefore my profit is 5. Therefore net profit upon cost will be 5 upon 80. I have to take cost in the denominator because I am selling. Why? I have told you the logic in the class. You can go and listen to the lectures. Divided by what? 80. This will come to 6.25%. This is my margin with my associate enterprise. Now what is the margin with unrelated party? What is the arm's length margin? The arm's length margin is, this is my total cost. Okay. This is my total cost. This is my profit. So 100 divided by 600, 16.67 is my profit margin. Okay. Now this is the arm's length margin that I have to apply on my cost. What is my cost? My cost is 30,000 hours I am providing. I am providing 30,000 hours, and 80 rupees is the per hour dollar rate, and multiply by 55 rupees is the dollar rate. This is my cost. On this cost, I will apply the arm's length margin and I will get my arm's length price. Then I will compare with my original price, whatever is the differential amount that I'm going to add it back. Okay. It is as simple as that in this question. So I need to find out the arm's length margin, and that arm's length margin I will apply on my cost. I will get the arm's length price. Okay. I hope it is clear to all of you. Now question number 3, beautiful question, which is on taxation of trust, which is on exit tax. In 2006, a trust was formed. In 2010, the trust was registered. Okay. So remember, when the trust was formed in 2006 till 2010, whatever assets were purchased by the trust, whatever liabilities are incurred by the trust, that will not come in exit tax. Okay. In exit tax, only those assets and liabilities will come which has been taken or which has been borrowed after the trust has got registration. Okay. So these assets and liabilities will not be forming part of your trust calculation, exit tax calculation. In 2023, the trust got dissolved. Now we need to find out the exit tax. What is exit tax? It is accredited income into 34.944% tax. Okay. Now how to compute the accredited income? You have to take the value of all assets minus value of all liabilities, and some assets and liabilities are not included in that. So that's what we are going to do the calculation as now. Okay. First of all, land and building. Land and building, the book value is 12 lakhs. We don't take book value of land and building. We only take FMV of land and building or stamp duty of land and building, whichever is higher. In this question, stamp duty value is not given. Therefore, we are taking FMV of land and building. Now, the FMV of land and building is what? It is 50 lakh rupees. Now, you have to be very careful with this adjustment. Lot of students ask me a lot of doubts over here. It is written in the question. It is written in the question in adjustment number 4 that land and building is acquired out of agriculture income. Now, it is very clear now. You have purchased a land and building of 12 lakh rupees. Out of which, you have taken a loan of 9 lakh rupees to purchase land and building. Can you see that? So out of 12 lakh, if 9 lakh has come out of loan, it means agriculture income has been used to the extent of only 3 lakh rupees, correct? If to purchase a land of 12 lakh, 9 lakh is coming out of loan only. So agriculture income is used to the extent of only how much? 3 lakh rupees. It means agriculture income is extended to the extent of what? 1/4 of the asset. Okay. Because out of 12 lakhs, 9 lakh is coming from loan. Therefore, only 3 lakh is coming from agriculture income. Therefore, agriculture income composition in the asset is only 1/4 of the total asset. Therefore, whatever asset is purchased from agriculture income, that does not come in the what? In the accredited income. Therefore, this is the FMB of the asset. 1/4, I will say, is purchased from the agriculture income. Therefore, I will take only how much? Only 3/4 of the asset in the calculation. I hope you understood. Because 1/4 is purchased from agriculture income. Therefore, only 3/4 should be taken in the value of accredited income. I hope it is clear to all of you. For Equity shares which are quoted, that is listed equity shares, you are supposed to take the market value of the asset, and the market value of the asset is given as 18 lakh rupees. Okay, it is as simple as that. For unquoted shares, you have to make a lot of calculation. Now listen carefully. The unquoted share of Z Limited, you have to make a lot of calculation. You need to value the unquoted shares of Z Limited, and then you have to multiply by how much percentage you hold in that particular company. Okay, now how to value that? You have been given all the data. The book value of all the assets are given 60 lakhs, then market value of bullion etc is given is 30 lakhs, then net assets is what? Minus 35 lakhs is the liabilities. Therefore the net assets of that Z Limited is 55 lakhs. Out of that, we hold only 15%. So how did you come to know that we hold only 15%? See, we hold how much? We hold 1,50,000. Out of which, what is the total equity capital of Z Limited? 1 lakh equity into 10. Therefore, for 10 lakh paid up capital, we hold 1.5 lakhs. Therefore, we hold how much? Only 15%. Therefore, the total worth of the company is 55 lakhs, out of which our worth is how much? Only 15%. In that also, I will take only 50%. Why? Because 50% of the assets, 50% of the unquoted shares were purchased in 2007-8. Because it was purchased before the registration, that asset will not form part of accredited income. Therefore, only 50% of the assets which is purchased after the registration. Registration happened in 2010. Only that much asset will form part of what? Accredited income. Therefore, asset which is purchased before 2007, before 2010 will not form part of accredited income. So this is how we are making the calculation. 55 lakhs is the total worth of Z Limited, out of which only 15% is our stake. Out of that, 50% is purchased before 2010. Therefore, only 50% of that will come over here as a value of the asset. Okay. Next, cash you will take entirely 1 lakh. Bank you will take 50,000. Then loan you will take 9 lakh rupees fully over here. This loan you are not going to take because this loan is taken before 2010. Any asset and liability which was acquired or borrowed before 2010 will not be considered over here because it is before registration. After that, you will get the accredited income. That's it. There is nothing great in that. One last thing, you have also distributed 88 lakh rupees of asset to another trust before the specified time. So that much you can reduce from here. Okay. So that much you have the opportunity. You are not going to take that. Okay. Because that asset, because the law says that if there is a dissolution and if you transfer the asset to another trust within 12 months, then that much asset should not be form part of what? Accredited income. So this shall not form part of accredited income. Okay. Now the next question is a very simple question, but only thing important in this question is this is going to be followed as per the 115 BSc subsection 1A. That is, you have to follow the new regime. So because of the new regime, this question becomes very important. Okay. Because from this year onwards, the by default regime is going to be the new regime, and accordingly the DTAA questions will also be impacted because of that. Now the very first thing over here is the SSC is 62 years age. He is a resident individual and he's earning some income. So I'll just make the computation for you all. Very simple. I'm not going to solve the entire question. Obviously, it's a very simple question. Gross salary 4,50,000 standard deduction. Then profession income from Brazil, dividend income from Brazil, rent 1,80,000, 30% standard deduction. Do you get in new regime? The answer is yes. In new regime, you get 30% standard deduction. Then FD from Pune branch. Then self-occupied interest not allowed under new regime. Self-occupied interest 2 lakh rupees not allowed. House property self-occupied interest not allowed under new regime. Then PPF not allowed. PPF ATC not allowed. Mediclaim not allowed. 80D not allowed under new regime. So accordingly you have to compute the income, and then you have to compute the average rate, and then you have to compute what? After computing the average rate, you have to compare with the foreign countries rate, and whichever is lower, that will be allowed as a relief on the doubly taxed income. Okay. So it's a very simple question after that. Now coming to the next question, question number 4, part A, which is on TDS. Very, very beautiful question. Mr. Z is a resident. What is he doing? He is selling some goods of worth of 60 lakh rupees through ABC e-commerce operator. So Mr. Z is a resident seller who is selling some goods through ABC e-commerce operator, that is through Amazon, etc. So Amazon has to deduct TDS under 194.0 at the rate of 1% on the time of credit or at the time of payment, whichever is earlier. So how Amazon is making the payment of credit? On 31st December, Amazon is making the credit of 20 lakh rupees. On that, Amazon will deduct 1%. On 28th Feb, Amazon is again making payment of 15 lakh rupees. So on that, Amazon will deduct 1%. Then the customers have directly paid to the seller. Customers have directly paid 10 lakh rupees to the seller. Will that also be subject to TDS? The answer is yes. Do you remember that? If the customer does not pay to Amazon, but the customer directly paid to the seller, then it is deemed to be credited by Amazon. Then that case also, this 10 lakh will be subject to TDS. Okay. And the balance amount is how much? 15 lakhs. Out of 60 lakhs, 35 lakhs gone here, 10 lakhs gone here, 45 lakhs gone. Then 15 lakh balance is credited on 31st March. So on 31st March, balance 1% will be subject to what? Will be subject to TDS. Okay. This is how in 4 steps the TDS will be deducted. By what? By Amazon. That is by ABC company in this question. Next question is also a beautiful question. Pay attention please all of you. Raghav Motors Limited. What is happening in this case? This assessee is engaged in what? He has a turnover of 9.8 crore in the last year from sale of cars and 60 lakhs from service station. So the total turnover of this assessee in the last year is greater than 10 crore rupees. It is a very important data for us. Okay. Now it is selling the following things to the customers. First, it is selling a Maruti car of 37 lakhs to a customer. whether TCS will be collected by the assessee or not. Yes, if you sell a car of more than 10 lakh rupees, then 2061F will be applicable. 1% TCS will be applicable to the seller. Okay. Then again a Maruti car of 19 lakh rupees. Again it is more than 10 lakh rupees. 1% TCS will be collected under 2061F. The third one is a Ford car of only to 8 lakh rupees. 2061F will not be applicable because the value of the car is less than 10 lakh rupees. Therefore, 2061F is not applicable. We'll talk about the Ford car in a while, what has to be done in that case. Okay. Then again a Maruti car of 12 lakh rupees. Again, it is more than 10 lakh rupees. Therefore, 2061F will be applicable at the rate of 1% in this case. Okay. So, for the first car, second car and the fourth car, because the value of the car is more than 10 lakh rupees, the seller is supposed to collect TCS at the rate of 1% under section 2061F. What about this Ford car? For this Ford car, do you remember that all those cars which do not come in 1F will come in 1H if provided you fulfill the conditions of 1H, because 1H full condition says what? Your last year business turnover has to be greater than 10 crore. Is the last year business turnover greater than 10 crore? The answer is yes. The second condition 1H says that you should sell the car in the current year of more than 50 lakh rupees. Is the assessee selling the car of more than 50 lakh rupees? Now there are two views taken over here by the ICAI. If we see all the cars taking together is greater than 50 lakhs. All the cars means which comes in 1F and which comes in 1H. All the cars means all four cars if I take together, it is greater than 50 lakhs. So the one view taken by ICAI is that because all the cars taken together is greater than 50 lakhs, so you collect TCS on 8 lakh rupees. Second view ICAI takes that because the car which is covered in 1H, only the car which is covered in 1H that does not exceed 50 lakh rupees, therefore you should not collect TCS in that case. So both the cases are covered over here, because in one case they have said that consider all the cars, in one case they have said that don't consider all the cars. Okay, so both the views are taken by ICAI in this particular question. You can see the solution later on. Next one is a question on chapter 12A. There is a non-resident and a person of Indian origin, therefore he is an NRI, and we have to opt for what ICAI has said that find the tax payable or refundable with special provision applicable to non-resident. It means you have to follow chapter 12A only. You don't have option to follow any other provision over here. Okay. Now what does chapter 12A says that if an NRI, that is non-resident Indian, purchases certain specified assets, then in that case long-term capital gains will be chargeable at 10%. Then the interest income, dividend income will be taxable at 10%, at 20%, and you will also be getting some exemption if you invest in the specified assets within 6 months. Okay, you will get some exemption under 5115F if you invest in specified assets within 6 months. Okay, now the very first thing, there is a long-term capital gains on specified foreign exchange asset. Is it covered in chapter 12A? The answer is yes. You are also incurring some expenses with respect to such transfer of 30,000, therefore 8,20,000 rupees will be taxable at 10%. But you are also investing in the shares of Indian Public Limited on 31st December. Within 6 months, if you are investing, then you get an exemption. But in this case, you are selling on 31st May, you are investing on 31st December, therefore you are not investing within 6 months. Therefore, this will not be subject to what? This will not be subject to exemption to you. Okay. If this would have been invested within 6 months, you would have got an exemption from 8,20,000 rupees. Then, apart from that, you are earning some interest on deposit from private company. Is it covered in 115? Is it covered in chapter 12A? No. Interest on deposit from public companies covered, from private companies not covered in chapter 12A. Therefore, this will be taxable at slab rate. Okay. Then, interest on government security, ICAI has taken two view. If it is in Forex, then it will be covered in chapter 12A. If it is not in Forex, then you have to apply what? Then you have to apply slab rates. Okay. So these are the two views which are taken by the ICAI in the solution. You can check, because in front of interest on security, it is not written whether in Forex, whether in Indian rupees. If it is invested in Forex, then you follow the chapter 12A. If it is not invested in Forex, then you follow the slab rates. Okay. Then you also have short-term capital gains, which will be chargeable at 15%, 111A. Then you are making some investments in notified NSC, that is National Savings Certificates. Then that will be subject to ATC deduction. If you follow old regime, if you follow the new regime, then you are not eligible for ATC. Okay. So after that, you are supposed to compute your tax payable. For computing the tax payable or refund, you have to also reduce your TDS which is deducted. That is 1,55,000 rupees TDS which is deducted in your case. You have to deduct that and find out what is the tax payable in this case. Okay. Now let's move on to the next question. The next question is a case law question. There are some case laws over here which I need to address all of them one by one. The very first case over here is on an issue that can a CIT revise an intimation under 143(1) under section 264. We all know that CIT has the power to revise an order under section 264. CIT does not have a power to revise an intimation under section 264. An intimation is not an order, but this is a contradictory judgment. In exceptional cases, the court has said that CIT can revise even an intimation under section 143(1). This case law is also there in our case law lecture. You can go and see the case law lecture also. You can go and see the case law book also, which is there in our color book number 2, chapter number 75 or 76. I don't know. You can just check it over there. Okay. Therefore, you have to be very careful with this that if a CIT revises an intimation, that is also allowed now as per this judgment. Okay. Now, the next question is, there is an assessee firm over here and the assessee firm has given a transport contract to a transporter. Now, this contractor doesn't have any truck and all, any car, etc. He doesn't have any vehicle. He has used the services of some other person. Okay. Now, whether I am liable to deduct the TDS? My question over here is, I am making the payment to a person who does not own any vehicle, but he has taken a vehicle from somebody else and he has provided me the services. Am I supposed to deduct TDS under 194C? The answer is yes. 194C is very clear that the transporter can be a contractor, the transporter can also be a subcontractor. In this case, the transporter is what? The transporter is a subcontractor. He has taken the truck from someone and he is giving you. And therefore, whether the transporter is a contractor or subcontractor, this doesn't matter. You have to deduct TDS in both the cases. Therefore, 194C is applicable. If you do not deduct the TDS, 40A1A, 30% expenditure will be disallowed under the income tax law. Okay. Next one, there was some order which was passed by the assessing officer in case of buyback of shares. So, assessing officer passed an order. Now, what did assessee do? Assessee, instead of going to a legal remedy to go to CIT appeal, he directly went to the High Court and filed a writ petition. My question to all of you is, can you directly go to writ petition? When you have a remedy under the income tax law, when the law says that if you are not happy with the order of the AO, you can go to CIT appeal. But can you skip that particular thing and directly go to the High Court for writ petition? The answer is no. Remember, I used to say in the class, a writ petition is only possible if there is no remedy in the law. If there is a remedy in the law, then you should not file a writ petition. You should go as per the law. Therefore, in this case, the assessee cannot go for the writ petition. Okay. I hope it is clear to all of you. Next one is a 2020 equalization levy. There is an assessee, Mrs. XYZ. It is an e-commerce operator. Now, remember, for 2020 equalization levy, what are the conditions? The assessee has to be an e-commerce operator. The assessee should not have a PE in India. The assessee should be non-resident. It is incorporated in China. It is non-resident and it should sell goods or provide services in India of at least 2 crore rupees. Then equalization levy is applicable. So all these conditions are fulfilled over here. It is selling goods of rupees 1.2 crore to Indian resident. So this will come in the 2 crore. Secondly, it is providing online sale of advertisement where if the amount does not exceed 1 lakh rupees. If the amount exceeds 1 lakh rupees for online advertisement, then 2016 equalization levy is applicable. But if the amount does not exceed 1 lakh rupees for online advertisement, both the options are possible. For online advertisement, if the payment is more than 1 lakh, then 16 equalization levy. If the payment is less than 1 lakh, then 20 equalization levy. Here it is less than 1 lakh. So this amounts to total of 70 lakh rupees. So 1.2 crore plus 70, it comes to 190 lakhs. Then you are also providing some services to non-resident for sale of advertisement that targets Indian customers. This also comes in the scope of equalization levy. This is also 20 lakhs. Therefore, the total comes to 2.1 crore. On that, 2% equalization levy will be charged and it will be paid by mrsxyz.com. Okay. I hope it is clear to all of you. One last question over here. Pay attention, please. One last question over here is of GAR. Okay. There is a company, Mrs. Highway Drive Limited, and which incorporates a wholly owned subsidiary, Mrs. Highway Roads Limited, etc., etc., etc. Okay. Now, we know that if you are engaged in some infrastructure, you are eligible for deduction under ATIA. Now, Highway Drive Limited derives income other than income from infrastructure. Derives income from other than infrastructure, but tries to claim the benefit under ATIA. So, if you are not doing infrastructure activity, still you are claiming deduction under ATIA, it's a clear case of tax evasion. And in case of tax evasion, GAR is not applicable. GAR is not applicable in case of tax evasion or tax planning. GAR is applicable in case of tax avoidance. That too, if that avoidance is not specifically covered over here. If there is a SAR somewhere, specific anti-avoidance of a rule, then GAR will not be applicable in this case. This is a clear case of tax evasion. The question of GAR does not arise. Okay. The second case is a very simple case. You can go through it. It's a case of domestic transfer pricing. There is one entity which is eligible for ATIA, another entity not eligible for ATIA. You are selling some goods at a lesser price to evade tax. Therefore, domestic transfer pricing will apply in this case. And because domestic transfer pricing will apply, GAR will not apply because there is a specific anti-avoidance rule in this case. Okay. Now, one last question is a theory question, but this is a very important question. A lot of time ICAI has asked this question, which is about provisional attachment. When a provisional attachment is made by the officer, can you revoke that provisional attachment? Can the officer revoke the provisional attachment? The answer is yes. What has to be done? I will show you directly from the solution what exactly you have to do in case of what? Provisional attachment revokement. Okay. The assessing officer, suppose assessing officer has what? Provisionally attach your property. Can he revoke your property? Can he revoke your property and give your property back? Yes, he can give you your property back subject to some condition. He will pass an order in writing, revoke the provisional attachment provided you furnish a bank guarantee to the officer. You have to furnish what? A bank guarantee to the officer of how much? From a scheduled bank. You have to take a bank guarantee from the scheduled bank of not less than the fair market value of the asset. Okay. Whatever is the fair market value of the asset, that much bank guarantee you have to give it to the officer. Okay. Now, can bank guarantee liquidate? Can officer liquidate that bank guarantee? Can officer invoke bank guarantee? Invoke bank guarantee means liquidate bank guarantee. The answer is yes. Suppose if there is a notice of demand on you and you have failed to pay the demand within the time, wholly or partly. If you are not paying your demand wholly or partly on time, the officer can what? Liquidate your bank guarantee. Or officer can also liquidate your bank guarantee when you fail to renew the bank guarantee. Suppose the bank guarantee is expiring and 15 days are left for expiring the bank guarantee and still you are not revoked the bank guarantee. Still you are not what? Still you have not what? renew the bank guarantee, and therefore in that case the AO can what? Liquidate your bank guarantee. So this is what this beautiful question paper is all about. Okay. So let's move ahead with the next paper, that is May 2022. The very first question over here is to be solved as per the 115BAA. Okay. So let's start solving as per 115BAA. The SSC is a manufacturing company. The profit is 850 lakhs. Depreciation will be added back. Employer contribution and employee contribution both are paid by 20th of May. Will it be allowed? Now listen, employer contribution can be paid till the due date of filing of return, but employee contribution has to be paid by 15th of the following month. With that logic, employer contribution paid till 20th May will be allowed. Employee contribution has to be paid by 15th of April. Because it is paid till 20th May, it is not allowed. Employee contribution will be disallowed. Okay. Next one, GST penalty is disallowed because it is penal in nature, and GST interest will be allowed because it is compensatory in nature. It is allowed as reduction. Next, 10 lakh rupees you have incurred for some notified skill development project under 35 CCD. So 35 CCD is not allowed in 115BAA. If you see 115BAA, 35 CCD is disallowed under that section. Then an old machinery has caught some fire. Because of that, there is a loss of 20 lakh rupees on fire of machinery. That will be added back because that is a capital loss, and you have also received 5 lakh rupees as a scrap value. You will reduce that from what? Reduce that from the PGBP income. This will have an effect in the WDV of the block of asset. Okay. Next one is a very important adjustment. You are receiving some dividend from foreign company of 15 lakh rupees. So reduce from here, show under IFOS. Now you are also incurring some expenses of 50 lakh rupees, 50,000 rupees, sorry. So you have to add back that interest to PGBP, and you can claim that as a deduction under IFOS if you assume that it is an interest, because only interest is allowed as a deduction from dividend income, that too up to 20% of the total dividend, not more than 20% of total dividend. Therefore, the net dividend taxable under IFOS will be 15 lakhs minus 50,000, that is 14 lakh 50,000 rupees. Next one is a very routine adjustment. You can go through it. I'm not interested in that adjustment. Next one is again a routine adjustment. Normal depreciation, you have to reduce it. Next one is, in the last year you have purchased some new plant and machinery on 10th of Jan. So you would have got additional depreciation of 10% in the last year, that is 50% of 20%. So in the last year you would have claimed 10% additional depreciation. Can you get the balance depreciation of additional depreciation in the current year? The answer is no. Why, sir? Because I am following 115BAA, and SSC opting for 115BAA is not eligible for additional depreciation. Therefore, that will not be allowed to you in the current year. Similarly, in the last year you have paid some money to a contractor, and for which the TDS is paid in the current year. So if the payment was made in the last year, but the TDS is paid in the current year, in the last year 30% would have been disallowed, but since the TDS is paid in the current year in December 2023, that payment of 30% will be allowed as deduction in the current year. Okay, I hope it is clear to all of you. And one last adjustment over here is, you are declaring and distributing dividend of 20 lakh rupees, so you can get deduction under ATM, but ATM is subject to dividend received minus dividend paid, whichever is lower. How much dividend is received by you? It is 14.5 lakhs net dividend. And how much dividend is paid by you? 20 lakhs. Therefore, only 14.5 lakhs will be allowed as deduction under ATM, and therefore now you will compute your tax under 115BAA. The tax rate is 22%, surcharge is 10%, and health and education cess of 4%. Surcharge of 10% is always applicable under 115BAA. Question number 2, it's on real estate investment trust. There is a REIT and there is an SPV. HATS Limited is an SPV, and there is an investor, Mr. Vijay, who holds 70% of the units of the REIT. Now we need to explain the taxability and compute the total income and tax payable in the hands of what? In the hands of the REIT also, and in the hands of the investor also. So let's talk about one by one all of them. First of all, the REIT is earning some income of interest. Interest income is earned from whom? From SPV. That is exempt in the hands of REIT and taxable in the hands of the investor. But remember, in the hands of Mr. Vijay, only 70% will be taxable, because Mr. Vijay is 70% owner of the REIT. He holds 70% units of the REIT. Okay. So accordingly, only 70% will be taxable in the hands of Mr. Vijay. Second, dividend income from REIT, dividend income from SPV is always exempt in the hands of REIT. In the hands of REIT, it is always exempt. In the hands of investor, it depends. It is exempt if the SPV has not followed 115BAA. But if SPV has followed 115BAA, then investor has to pay tax on what? On the dividend income. In this question, it is written that HATS Limited, which is an SPV, follows 115BAA. Therefore, dividend income will be taxable in the hands of the investor. I hope it is clear to all of you. Short-term capital gain is taxable in the hands of the REIT at MMR 42.744% and exempt in the hands of the investor. Similarly, interest from investment in unlisted debenture, it is taxable in the hands of the REIT and exempt in the hands of the investor. And last but not least, rent from directly owned properties. It is exempt in the hands of the REIT and taxable in the hands of the investor. Okay. Now remember, investor has to pay tax only on 70% of its income, because only 70% is held by Mr. Vijay in the REIT. We are making one more assumption that the REIT has distributed 100% income to the investor, because in case of REIT, only that much income is taxable in the hands of the investor, which is distributed. If nothing is distributed, then that income will not be taxable in the hands of the investor. Unlike AIF and securitization trust, where there is a concept of deemed credit, here there is no concept of deemed credit. credit. One more important thing which you need to follow over here is the SSC is following 115 BSE subsection 1A. It means it is following the new regime, and therefore in new regime the maximum surcharge is how much? It is 25%. If you compute the total income of Mr. Vijay, it goes beyond 10 crore. But Mr. Vijay will not be subject to 37% surcharge, because in the new regime the maximum surcharge is only 25%. I hope it is clear to all of you. The next question is also a very good question, small question, simple question, but a good question. Black and Brown, it's a foreign company incorporated in country X. Now they have appointed one agent, Mr. Lal, to habitually maintain in India stock of goods, regularly deliver the goods on behalf of the non-resident. Now do you remember that if a non-resident or a foreign company appoints an agent in India, dependent agent in India, who habitually supply goods in India, who habitually maintain goods in India, deliver goods in India, secures orders in India, or habitually enter into a contract with any party in India on behalf of the non-resident, then it is a business connection in India. Do you remember that or not? It is covered under 911. Now what all incomes is earned by BNB? BNB has earned the following income. First, BNB has earned an income from delivery of goods by Mr. Lal. That is, the agent has delivered some goods. From that, BNB has earned income. This will be taxable in India, and it will be taxable at 40% because the tax rate of foreign company is 40%. Next point is very important. The BNB has also earned, the foreign company has also earned foreign FTS of 55 lakh rupees after deducting 6 lakhs as an expense. Now remember, here the ICAI has taken two views. First view, the ICAI has said that assume that this is an FTS as per 115A. If it is an FTS as per 115A, then this will be taxable at 20%, but then you will not get the deduction of 6 lakh rupees. Your income will be 61 lakh rupees. Okay, that is 55 plus net of expense. Now it is, so you have to add back the expense. But if you assume that it is not as per 115A, it is a normal FTS, it is not covered in 115A, then you will be taxable at 55%, 55 lakhs at 40% tax rate. Whichever view you want to take, you can take. Both the views are correct. Next, long-term capital gain on unlisted shares of an Indian company. It is taxable at 10% for non-residents under section 112. And then BNB has paid some tax in his own country. So what will we have to do with that? We have nothing to do with that. If BNB has paid some tax in its own country, we cannot give FTC to BNB. We will give foreign tax credit to whom? We will give DTAA relief to whom? Or unilateral relief to whom? Our residents, not residents of country X. So this is just given for the sake of confusion to the students. Okay, so ignore this particular point. This is not relevant for us. Now coming to the third question. The third question, part A. In part A, there are questions which are with respect to taxation of trust. There is a trust who has received some corpus donation. Now the trust is saying that because I have received corpus donation, this is exempt because this is for a specific direction. Can I directly say it is exempt? The answer is no. If a trust wants to exempt its corpus donation, it has to invest in the mode specified in 11.5. Otherwise, it cannot be exempt. Similarly, a trust has taken a loan of 20 lakh rupees and has incurred 18 lakh rupees on construction of building. Whether that can be considered as an application? No. If a trust takes a loan and apply that money, that is not considered as an application because the law says that you have to repay the loan. If you repay the loan, then it is allowed as an exemption. Otherwise, it is not allowed as an exemption under the income tax law. Next one, Smile Foundation. It's an institution, not for profit institution, runs a secondary school. It has received 30 lakh rupees of grant from private people and from government also. And the trust says that is it necessary to get an approval to claim exemption? Now remember, if a trust is substantially financed by government, then it is not required to receive any approval from any person. What do I mean by substantially financed by government? It means more than 50% of the grant is received from the government. Now this trust, this institution has received a grant of 30 lakh rupees, out of which how much is received from government? 16 lakh is received from government. Therefore 53.33% is received from government. Therefore such kind of institutions for education or a medical purpose are not supposed to get an approval. They can directly claim exemption. There is no harm in that. And one last thing over here, in this particular part, there is a trust who is registered under 12AB. And at the same time, the trust also got an approval under 1023C. Now the trust wants to enjoy both 12AB and 1023C. Is it possible to enjoy both of them? And the answer is no. A trust cannot enjoy both 12AB and 1023C at the same time. It is not allowed. It is written in section 11, subsection 7, that you can enjoy either 12AB or 1023C, not both at the same time. Okay. Now next question is a beautiful question. Mr. Chetan is an Indian citizen. He is 51 years old. He left India in 2020 to settle in country Y. Now, because of some reason, he came back to India permanently on 1st June 2020. So, on 1st June 2023, if he is coming back to India, so from 1st June 2023 to 31st March 2024, he stayed in India for 305 days. Therefore, he is definitely a resident in India. Now, is he an ordinary resident? The answer is yes. Sir, how can you say that? Because in the last 10 years, definitely he is staying in India for 2 years. For 2 years, he is definitely a resident because he left India in 2020. Before that, for the last 7 years, he was in India only. Therefore, he will definitely fulfill both the additional condition of 730 days as well. the residential status in 2 out of 10 years. Therefore, he is ordinary resident. Therefore, his world income is taxable. The first income which he is earning is, he is earning some rental from a country property in country by 25,000 is the rental, $25,000 is the rental income. Now you have to convert that into rupees. So if a person is earning dollars, then income in dollars, then house property will be converted into rupees as per what? As per rule 115. Rule 115 says that the house property income should be converted as per what? As per the TTBR as on the last day of the financial year. So what is the TTBR as on the last day of the financial year? It is 75 rupees. You can check over here. So you should multiply $25,000 into 75 and then you will take 30% standard deduction that is allowed to you. Okay. Take 30% standard deduction. Apart from that, he is earning some business income in India, 5 lakh that you have to add. He has also received some dividend from an Indian company. Now you have to be very careful. From an Indian company, if you receive a dividend, then the Indian company would have deducted the TDS of 10%. Therefore, this 1,25,000 you have to gross it up. This 1,25,000 is 90%. So therefore, 100 is how much? Gross it up and show. You have to be very careful with that. Then interest from saving bank of 11,500. From that you can claim 80 TTA. Assessee does not offer 115 BAC. He is going for old regime. Therefore, 10,000 you can claim as a deduction under 80 TTA also. Okay. Now after doing all those things, you have to compute the tax normally, and whatever the tax comes, that comes to 3 lakh, that is 4,14,302, and that 4,14,302 divided by the total income, you will get the average rate in India. Now I want to compute the average rate in foreign country. What is the average rate in foreign country which he has paid? He is paying tax only on one income in foreign country, and that is house property income. That is on this $25,000. But is he really paying tax on $25,000? The answer is no. He is paying 20% tax definitely on after taking a basic exemption limit of 8,000 in that country. Therefore, he is paying 25,000. He is paying 20% tax on $25,000 minus $8,000. Therefore, he is paying tax on $17,000 20%. That is, he is paying $3,400 as a tax. Therefore, what is the average rate in foreign country? It is $3,400 divided by $25,000. That is 13.6% is the average rate in India. Therefore, what will be the relief given to him? It will be the average rate in India, average rate in foreign country, whichever is less, that will be allowed on his house property income, which is doubly taxed income. Okay, I hope it is clear to all of you. So it's a beautiful question. You can go through it once. It can repeat in the examination also. The next question is based on TDS. The next 3 questions is based on TDS or either TCS. Question number 1, 4A subpart 1. There is a Mr. Person, Mr. Rajat, 79 years age. He is retired resident. He is earning some income from saving bank interest, FD interest, and is also earning some pension. Now for him, section 194P will be applicable. Do you remember? If there is an individual who is resident, who is 75 years or more, and is earning income from what? Interest or on bank, and also pension from the same bank, then he is not liable to file the return if the bank has deducted the TDS. Okay. So for this, the bank will compute the income. 75,100 saving bank interest. 55,000 into 12 minus 50,000 standard deduction. He is following old regime. So in the old regime, new regime, in both the regimes, standard deduction is allowed now. And 1,20,000 FD interest. From that, he will claim 80 TTB because he is following old regime. He will get 80 TTB. Whatever is the tax, that will be deducted by the bank. And then Mr. Rajat is not liable to file what? The income tax return. The next question is on 194 IC. Do you remember that? If we give our property to any builder and the builder redevelops the property on that and gives us some money, so builder is giving us 2 things. He is giving us cash portion and he is also giving us some extra immovable property, new flats in the new building. Therefore, whatever cash portion he is giving me, whatever money portion he is giving me, he will deduct TDS under 194 IC. So in this question, he is giving me a consideration of 6 crore rupees in cash, in money portion. So that will be subject to 10% TDS under 194 IC if I am a resident. If I am a non-resident, then 194 IC is not applicable. Okay. The next question is a beautiful question. Mrs. Aryan is a domestic company whose last year turnover is more than 10 crore rupees. Now, Mr. Aryan has purchased goods of 85 lakhs. Therefore, Mr. Aryan is definitely liable to deduct TDS under 194Q. Why? Because Mr. Aryan is a buyer whose business turnover of last year is greater than 10 crore rupees and is purchasing more than 50 lakh rupees goods. Therefore, Mr. Aryan is liable to, Aryan Limited is liable to deduct TDS under 194Q in excess of 50 lakh rupees. Now listen carefully. First purchase is made on 25th of May. So on 30 lakhs, no TDS because it is not exceeding 50 lakhs. Next purchase is made on 28th of June. On 25 lakhs, he will deduct TDS on 5 lakh rupees 0.1%. Okay. Only on 5 lakh rupees 0.1% TDS will be deducted because 5 lakh is exceeding 50 lakh rupees. Next purchase is made in December 2022. 20 lakh rupees you will deduct because already 50 lakh threshold is crossed. 20 lakh rupees you will deduct TDS at the rate of 0.1%. Okay. I hope it is clear. Now, out of this 20 lakh, you have returned 5 lakh rupees goods because you did not like the product. So you returned back and you took the refund. Now what happens? Now there is a CBDT circular which says that if you have deducted the TDS and then you return the goods and you take the refund, then whatever refund you have taken on that much amount TDS, you can adjust against the same seller on the next purchase. Okay. So next time when you purchase of any amount more than 5 lakh rupees, you are not supposed to deduct TDS on 5 lakh rupees. So next purchase I am making in Feb 2023 of 10 lakh rupees. So at that time I will deduct TDS only on 5 lakh rupees, 0.1%. I hope it is clear to all of you. And the fourth and the last question is state, there are two transactions in this fourth question. State government of Telangana is leasing some coal mine to XYZ company limited. So if any person leases a coal mine or a parking lot, etc., there are some 3-4 points. Then the person who leases is liable to collect TCS at the rate of 2% under section 206C subsection 1C. So I am leasing a coal mine. I am supposed to collect TCS at the rate of 2%. Okay. Now this message XYZ is selling a coal. So if a person is selling a coal, then that person is liable to collect TCS at the rate of 1% under section 206C subsection 1. Okay. I hope it is clear to all of you. So there are two transactions in this particular question. Next question is a question on equalization levy. Equalization levy, there is a Shine INC, which is a foreign company, and this company does not have a permanent establishment in India, and this company is providing some online advertisements in India, and we are making the payment of more than 1 lakh rupees. Therefore, equalization levy of 2016 will be applicable in this case. Now in this case, we are making the payment of advertisement on 15th of March, and we have deducted the equalization levy on 15th of March. So if we have deducted the equalization on 15th of March, what is our duty? Our duty is to pay by 7th of April. Now, if we are not paying by 7th of April, then there will be an interest at the rate of 1% per month or part thereof. We are paying on 15th of April. Therefore, there will be an interest of 1% for 1 month. Okay. Now, how much is the equalization levy? On 5 lakhs, 6% will come to 30,000. 30,000 is the equalization levy. On that 1% interest will be charged at the rate of 1%. 1 month, it will come to 300 rupees. I have to pay as an interest. Will there be any penalty? Yes, there can be also penalty imposed by the assessing officer for not paying the equalization levy on time. Can I get some waiver from that penalty? Under what circumstances penalty cannot be imposed? It's a very simple line. If you prove to the AO that there was a reasonable cause for delay, then the AO will not impose the penalty. Otherwise, he will impose the penalty. Last but not least, if AO imposes the penalty, then what is the remedy with you? Then what is the remedy with you? You have to go and appeal to CIT appeal within 30 days from the date of receipt of an order. Okay. I hope it is clear to all of you. One last question over here in this paper. You need to identify this in these 4 cases, whether it is tax planning, tax management, or tax evasion. In first case, you are purchasing some Sukanya Samriddhi scheme to reduce your scheme. It is allowed as per ATC. Therefore, it is tax planning. Okay. In second case, you are taking from customers some form number 60 because the customers are not giving the PAN. They do not have a PAN. So instead of PAN, if the other person does not have a PAN, you have to take what? Form 60. So it is a tax management case. Okay. You are managing your tax in a proper manner. Third case, you have bought a refrigerator which is kept at home, but you are claiming depreciation on that by showing it in office. It's a clear case of tax evasion. Therefore, it is a tax evasion. Okay. Next, you are paying some 4 lakh rupees salary to your wife, but you are deliberately increasing the salary to 5 lakh rupees so that the company should get more deduction. And the wife is anyways exempt up to 5 lakh rupees because you are increasing from 4 lakh to 5 lakhs. Company will get 1 lakh extra deduction. But anyways, wife is exempt from tax. Therefore, this is a tax evasion case. Therefore, this will be called as tax evasion. And the last question over here is a theory question. You can go through it. Nothing great I said, not important also. That's why I'm not reading that. Okay. So this is what this paper is all about. So let's go ahead with the next paper, that is November 2022. Now we need to solve this question. Normally we are not supposed to follow any 115 BAA or something like that. A normal question, we have to compute the total income of the assessee. Now one very important thing in this question is the assessee is a company in which public are not substantially interested. It means it is a closely held company. And remember, whenever there is a closely held company, there are certain important provisions which can be applicable in the exam. That is section 79, that is section 5627B and section 68. These are the 3 very important sections which are applicable to closely held company only. And some of them are there in this question also. Now, the very first thing, the assessee is a manufacturing assessee. So accordingly, you have to need to answer the question. One-time license is paid for 12 lakh rupees. Now, what is the treatment that we generally give for this? You have to add back this license because this is an intangible asset. So add 12 lakhs and take 25% intangible asset depreciation under section 32. But unfortunately, in this question, ICI has taken 2 views. One is the view which I have told you. The second view which ICI has taken that you add 12 lakh rupees, but do not reduce 25%. They are assuming that the depreciation which they are giving to us over here of 14,50,000 rupees, that already includes what? That already includes the amount of what? Depreciation on the intangible asset. But this treatment was not given by ICI in the earlier questions. So you can do any of the 2, whatever ICI has done in this question. In this question also ICI has taken both the views. So you can take accordingly both the views. Okay. Then you are incurring some expenses for issue of convertible debenture, that is allowed as reduction. Convertible debenture does not amount to permanent capital base in the company. Therefore, the expenditure incurred to issue convertible convertible debentures are revenue in nature. You can claim that expenditure. Okay. The next one is a very intelligent adjustment, very new adjustment. Pay attention, please. You are paying some money to share broker for purchasing some shares, and some money to commodity broker for purchasing some commodity, and on in both the transactions you have not deducted the TDS. Now in this case, the ICI has taken two view. The first view is the ICI has taken the first view as the assessee is a trader in share or trader in commodity. If the assessee is a trader in share and trader in commodity, then the deduction will be available under PGBP. But deduction will be available when? In case of shares, there is no need to deduct TDS. Go and see section 194H. It is very clearly written. In case of share broking, you don't have to deduct TDS. But in case of commodity broking, you have to deduct TDS. So therefore, in case of share broking, because you are not deducting TDS, your expenditure will be disallowed to the extent of, in case of share broking, no disallowance, because in share broking, there is no need to deduct TDS. But in case of commodity broking, there is a need to deduct TDS. Therefore, you need to disallow 30% of that. The second view which ICI has taken is they are not dealer in share, they are not dealer in commodity. If they are not dealer in share, not dealer in commodity, then the question of deduction does not arise. Both the cases, it will be disallowed. Okay. Next one is a very simple adjustment, but an important one. The company is paying 15% of the basic salary to the pension account, which is allowed as deduction under section 36(1)(4)(a). But how much is allowed as deduction? Only 10% of the salary and basic salary and DA in terms. Only 10% of basic salary and DA in terms is allowed as deduction. But how much is company contributing? Company is contributing 15% of the basic salary. Now, what is the basic salary of the employee? It is 6 lakh rupees. What will be 15% of that? 90,000. So company is contributing 90,000 rupees. But out of that, how much will be allowed? Only 10% of basic and DA in terms. Now, the basic is 6 lakh rupees. What is DA? DA is 30%. So 30% of 6 lakhs will come to 1,80,000. Out of that, only 50% is DA in terms. So therefore, out of 1,80,000, only 90,000 is DA in terms. Therefore, basic plus DA in terms is how much? 6 lakhs plus 90,000, 6 lakh 90,000. The deduction is allowed 10% of 6 lakh 90,000. Therefore, deduction will be 10% of 6 lakh 90,000. That is 69,000. How much you have actually paid? Actually, 90,000 you have paid. Therefore, 21,000 will be disallowed under the income tax law. Okay. Next one, you are making some payment of 7 lakh rupees to as a freebie to medical practitioner. That is disallowed as per explanation 1 to section 37(1). Explanation 1 to 37(1) clearly says that any freebie to medical practitioner will be disallowed under the income tax law. Next, you are incurring some expenses on feasibility study for enhancing your existing business, but the project was abandoned unfortunately. So because the project is abandoned, there is no asset created. Therefore, this expense will be allowed as a revenue expense. Don't worry about it. Depreciation will be disallowed. Next is employees provident fund has to be paid by 15th of the following month. You are paying on 17th of May. Therefore, it is disallowed. Employer contribution can be paid up to the due date of filing of return. You are paying before the due date of filing of return. Therefore, it is allowed under the income tax law. Donation to Swachh Bharat Abhiyan allowed. Here you have to, in PGBP you have to add back. In chapter 6 you can claim, but you have to write a note that it is other than cash, because in cash if you pay more than 2,000, then deduction under 80G is not allowed. Industrial tariff concession you are receiving from central government. Any kind of concession receipt from central government is an income under section 224(18). If you remember, we have done it in PGBP. Next one, you have made a mistake of including interest and borrowing cost in opening and closing stock. So rectify that mistake. In opening stock, you are including the interest of 6,85,000. So you have to add back that much opening stock in the P&L account, and in closing stock, you are including 5,65,000 as interest. So you have to reduce that from the P&L account, that much interest. Okay, I hope it is clear to all of you. Next adjustment, you have purchased some warehouse for agriculture purpose, that is for storage of sugar. Now this is covered under 3580, and 10 lakh is your profit from that. How much is the capital expenditure that you have incurred? That is given in the last point. 35 lakhs is the capital expenditure you have incurred, out of which 10 lakh, 20 lakh is land. Therefore, land will not be allowed. Therefore, 35 lakhs, land exclude. Therefore, only 15 lakhs will be allowed as deduction under 3580. What is your income under 3580? 10 lakhs. What is your expenditure under 3580? 15 lakhs. Therefore, 5 lakh rupees loss. It cannot be set off against other profits. It can set off only against PGBP. It can set off only against 3580 income. It cannot be set off against other incomes. Okay. Next adjustments are some additional information. You are receiving some 14 lakh rupees as GST from the customer, and then you have remitted that GST to the government. So therefore, receive 14 lakhs, paid 14 lakhs, knocked off. It is allowed as a reduction. Then you file an appeal to the court, and the court gave you refund of 5 lakh rupees. So the court gave you refund, and you refunded back to the customer only 3 lakh rupees. So you received 5 lakh from the government, and you repaid only 3 lakhs. Therefore, 2 lakhs should be added to the P&L account as an income. Whenever it will be paid, it will be allowed as reduction. Okay. Next one is a very important adjustment. Now this is the target of this question, 5627B. Because this company is a closely held company, so for a closely held company, section 5627B is applicable. Angel taxation, if you remember. So in 5627B, you cannot raise money more than the fair market value of the share. The fair market value of the share is 19. You are raising the price, you're raising the fund at 22. Therefore, the differential amount will be considered as income from other source. 3 rupees is income from other source into 2 lakh shares. Therefore, 6 lakh rupees should be added to the income from other source. Similarly, the next point is about section 79. What does section 79 says that? That is the year in which you incur loss and the year in which you want to set off the loss, at least 51% of the shareholders have to be same. And section 79 is also applicable only to what? Only to a closely held company. So in this case, in the year 2021-22, when the loss was incurred, 55% shares were held by Mr. X, and in the year in which you want to set off, it is sold to Mr. Y. Therefore, 51% of the shareholders are not same. Therefore, this loss cannot be carried forward and set off. And the last is 14,50,000. You will claim as a depreciation. Okay, under the income tax law. After that, the tax rate over here will be what? The tax rate over here will be. They have not asked the tax rate, so don't compute the tax rate. That's it. Okay. Let's move on to the next question. Question number 2 over here. This question is on LLP, and there are a lot of things over here. Whenever there is a question on LLP or partnership firm, you need to always be careful about what? You need to always be careful about the book profit first of all. You need to compute the book profit, and then the remuneration, and then the total income, and then the tax liability, and then the adjusted total income as per AMT if there are 10AA etc. in this particular question. In this question, there is 10AA also. So therefore, there are a lot of things which we need to compute over here. We need to compute the income tax. We need to compute the AMT. Lot of things have to be computed. We will compute all of them one by one. First of all, we will compute the book profit. How to compute book profit? Book profit is nothing but PGBP only. PGBP, add remuneration. Whatever comes in PGBP, add remuneration, that will give you book profit. Therefore, the net profit as per PNL is 65 lakh. The very first thing is profit from sale of import entitlement license. Yes, it is a part of book profit. It is covered in section 28. Whatever comes from section 28 to 44 will be part of book profit. Okay. Next one, you are giving some remuneration to working partner. You have to add back to the profit to get the book profit. Okay. Next, you are giving 16% interest to partners. Therefore, 4% will be disallowed under the income tax law. Next one, donation to political party. That is covered under section 80. Therefore, this will be disallowed while computing the book profit. Next one is depreciation. Therefore, it will be disallowed, and the account taxation depreciation will be allowed to the extent of 26 lakh rupees. Okay. Next one. Will you reduce the brought forward loss to compute book profit? No. Brought forward losses are not covered under section 28 to 43. It is covered under section 70 to 80. Therefore, brought forward loss will not be adjusted now. It will be adjusted later while computing the total income. Will you adjust the unabsorbed depreciation? The answer is yes. Once I do this, I have done all the adjustments, and now I will get the book profit as 87 lakh rupees. On 87 lakhs, how to compute the book? How to compute the remuneration? On first 3 lakhs, 90%, and on the balance 84 lakhs, it is 60%. Answer comes to 53 lakh 10,000. My actual remuneration in the question is 58 lakh. Therefore, I will be getting the deduction of only 53 lakh 10,000 rupees. 33 lakh 90,000 will be my profit, and after this profit, I will reduce what? My losses. My losses, brought forward losses of 4 lakh rupees, I will reduce after this. And after this, there is one 10AA deduction that I need to take care of it. Okay. Now, what is 10AA? How to compute 10AA? It is profit from export into export turnover divided by total turnover. Now, for taking the profit, what is the profit? The profit over here is 29 lakh 90,000 rupees is my profit. But ICI has taken two view. In one case, ICI has taken the profit as 33 lakh 90,000, which is before setting off loss. And in another case, ICI has taken the profit as 29 lakh 90,000, which is after setting off the loss. Both the answers are correct. Whatever you want to do, the answers will differ, but both the answers are correct. Don't worry about it. Okay. Now, what is export turnover? What comes in export turnover? The total export turnover is 45 lakh rupees. Okay, 45 crore rupees. Out of it, only 38 crore is received in India. So remember, in export turnover, you only take that much turnover which is received in India within 6 months. If it is not received in India in convertible foreign exchange within 6 months, you do not take that turnover in the export turnover. Therefore, only 38 crore will come. Out of 38 crore also, 2 crore is your telecommunication charges. So, export turnover has to be an FOB price. It cannot be CIF price. Do not include insurance, freight and other charges in the export turnover. Only the FOB price has to be there. Only cost has to be there. Therefore, 38 crore is received in India. Out of that, 2 crore is telecommunication charges. Therefore, export turnover is 36 crore. What is the total turnover? Total turnover is 45 crore. Out of which only reduce what? The charges. Even total turnover is your FOB price. It is not a CIF price. So in total turnover, there is 5 crore rupees of what? Telecommunication charges. So remove that. So therefore, total turnover will come to 40 crore. Therefore, profit into 36 crore divided by 40 crore will give you what? Will give you the deduction over here. And profit has to be two profits. One is before loss, one is after loss. Both the answers are correct. After that, you need to compute the deduction under 80 GGC. 80 GGC, why sir? Because you are giving donation to political party. That is allowed as deduction under 80 GGC. And after that, you will compute the tax liability. The tax liability of the firm is 30%. Now you will compute what? AMT. For computing AMT, you need to compute the adjusted total income. What is adjusted total income? It is nothing but your total income. That is 4,49,000 rupees. And then you have to add what? Add the deduction claimed under 10AA. Whatever is the deduction claimed under 10AA, that you will add back. After that, you will apply 18.5% tax. 4% cess, no surcharge because adjusted total income does not exceed 51 crore rupees. Otherwise, you would have applied surcharge also of 12%. In this case, no surcharge. After that, you will compare with your original tax, whichever is higher will be paid, and if the AMT is higher, then you will also get AMT credit over here. Okay, so this is how this question will be solved. It's a beautiful question. Let's move ahead with the third question. The third question is on a trust question. There is a trust which is engaged in promotion of yoga. Is an assessee engaged in promotion of yoga eligible for charitable purpose? Yes, an assessee engaged in promotion of yoga is a charitable purpose as per section 215. Now, this trust has received a donation of 125 lakhs as a corpus donation, and they have invested that in Blend and Blend Private Limited Company shares. Can you get the exemption? The answer is no. You have to. If a trust want exemption of corpus donation, they have to invest in the mode specified in 11.5, and 11.5 does not include shares of private company. Therefore, it will be taxable. The second trust, the second case, they have received 125 lakhs, 95 lakhs from voluntary donation, 60 lakhs from what? Some providing fees. So this is normal income, and you can take 15% exemption out of it. There is no harm in that. Okay. The next question is very critical. Pay attention, please, all of you. There is a founder of a trust. Mr. Nagaraj, who is running a charitable trust. That is, he is running an hospital, and in his hospital, his son was admitted. His son was admitted due to COVID, and his son was admitted, and therefore he paid what? Only 3 lakh rupees against 5 lakh rupees. So he is giving benefit to his son. How much benefit? 2 lakh rupees. To other people, they charge 5 lakh. To trustee's son, they are charging only 3 lakh rupees. This is wrong. The trustee's son, that is relative of trustee, comes under the specified person under section 13 subsection 3. The answer of this question in the solution is slightly wrong because it is as per the old provision. As per the new provision, multiple provisions will apply now, because the trust is providing undue advantage to the relative of the specified person. Therefore, the trust will be liable for a penalty under 271 AAE. 100% of the benefit provided in case of first mistake. In case of subsequent mistake, 200% of the benefit provided. Similarly, the trust will also be liable for tax at the rate of 30% under 115 BBI, and even the receiver of the gift, the receiver will be liable for gift taxation to the extent of 2 lakh rupees. That is the son's, that is the trust relative, that is the trustee's son will be liable to pay tax on 2 lakh rupees under income from other source. I hope it is clear to all of you. Now, the next question is again a beautiful question. There is a person, Mr. Ritesh. He is an individual, he is a resident, and his age is 42 years. Now he is earning income from multiple countries. He is earning income first of all from business in India. So 4,85,000 you will write in the income statement. Then he is earning royalty of 7,80,000 rupees from country N, and it says written in the DTAA between India and country N that this will be taxable in the source country. It means it will be taxable in country N. Therefore, this 7,80,000 will not be written in the income statement. So don't write in the income statement because this royalty is taxable in the source country, and the source country is country N. Therefore, it is not taxable in India. Similarly, interest from country Y he is earning $9,500. Now, this interest from country Y is taxable in both the country as per DTAA between India and country Y. It is written that it is taxable in both the states. That is, and India will give the credit on that particular amount on doubly taxed income. Whatever is the doubly taxed income, on that much amount India will give the credit. Now, this is the most important part of this question. First of all, this is taxable in India. This is taxable in country Y also, and India will give DTAA relief because he is a resident of India. Now, $9,500 he is earning. How will I convert that into rupees? You have to convert that into rupees as per rule 115. When you want to convert a foreign income into Indian income, you need to convert as per rule 115. Now, it is not clear which interest it is. It is normal interest or it is interest on security. We are assuming it to be other than interest on security, because in case of interest on security, you have to take the TTBR of the preceding month. In case of other than interest of security, you have to take TTBR of the last day of the financial year. So we are assuming this interest to be, because it is not clear which interest it is, we are assuming this interest to be other than interest on security. So I am taking TTBR as on the last day of the financial year, that is 80 rupees, 31st March 2024. This will be my income. Okay. Now, that is the next income, agriculture income in country M. So in country M it is exempt, but in India it is not exempt. So in country M it might not be taxed, but in India we have to tax 1,09,000 rupees. It will be added to the income statement in India. Now, after that, very simple, 4,85,000 PGBP income, royalty will not come because it is taxable in the source country, not in India. Interest will come as per 9,500 into TTBR also on 31st March, and 1,09,000 agriculture income taxable in India, exempt in country M. Okay. After that, you compute tax as per normal provision. That is whatever is the old regime. We are following old regime over here to follow as per the old regime. Okay. Now, that is coming to 2,27,448. Now we need to give him relief. Relief under which section? Relief under section 90. Why 90? Because there is a DTAA between India and the other country. Now, will we get relief in case of royalty? In case of royalty, there is no double taxation. So, why relief will be there? Royalty is only taxable in the source country. Therefore, no relief. Will we get relief in case of agriculture income? In case of agriculture income also, there is no double taxation. Only taxable in India, not taxable in foreign country. Therefore, no relief. Will we get relief in case of country by interest? Yes. In that case, we are going to get relief. Now, how much tax we have paid in foreign country and how much tax we have paid in India? Whichever is lower, that will be allowed as a relief. Okay. Now, how much tax we have paid in foreign country? Let's try to find out that. $9,500 is our income and $950 we have paid as a tax. Now, on which date we have paid the tax? On 21st of February 2024, we have paid the tax. So now we need to convert that into INR. Now, how to convert the foreign tax into INR for claiming FTC? You have to take TTBR of the last day of the preceding month. Now, what is the TTBR of the last day of the preceding month? It is 78. $950 into 78, 74,100 rupees will be the tax which is paid in the foreign country. Now, how much is the average tax paid in the Indian country? For that, we need to find out average rate in India. The tax paid in India is 2,27,448 and the total income is 13,54,000. Therefore, the average tax paid in India is 16.7498%. Okay. Now, listen carefully. And what is the tax paid in foreign country? 74,100. Therefore, how much is the doubly taxed income? The doubly taxed income is only this income, 7,60,000. So, on this doubly taxed income, if I apply the Indian average rate, it is coming to 1,27,000. Therefore, 1,27,000 is the tax paid on that doubly taxed income in India and 74,100 is the tax paid on that doubly taxed income in foreign country. Therefore, whichever is lower will be allowed as relief and therefore 74,100 will be allowed as relief under section 90. I hope it is clear to all of you. It's a beautiful question. Let's move ahead with the next question, which is a question on TDS. Next question is, the SSC has imported some computer software for reselling it to the end user. Remember, when you purchase some computer software for end use or for reselling it, for end use or reselling it, it is not a royalty because as per Supreme Court, in the case of Analysis Engineering Excellence Private Limited, it is not royalty. When you purchase the computer software for reselling it or for end use of it, it is not a royalty, and because it is not a royalty, then TDS is also not applicable in this particular case. Second case, a public sector company is paying some 20 crore rupees to an organization for providing some services with respect to ATM network to the bank as a commission. Whether TDS will be deducted under 194H or 194J. First of all, 194H is not applicable. When we went to the facts and circumstance of this case, we come to know that both of them, that the bank and the organizations are working on a principal basis. They are not working on a principal agent basis. Both of them are working on a principal basis. Therefore, 194H is not applicable. Now, whether 194J will be applicable, 194J is applicable in case of professional services, whereas where there has to be some kind of manual or human intervention, the court said that there is no manual and human intervention between both of them. Therefore, it cannot be deducted under 194J also. Okay. The next question is also a beautiful question. I am PQR Limited, you are Mr. A. Okay. I am PQR Limited, you are Mr. A, and there is my related party Fashion Limited over here. Okay. Now, I have told you that I want some shirts from you. Okay. So, you asked me from where will I get the clothes? I said that Fashion Limited, my related party will provide you the shirt and then you will stitch the shirt and give it to me. Whether I am liable to deduct the TDS or not, the answer is yes. The law says under 194C, if the material is provided by the SSC or the related party, then the TDS has to be deducted by me. Now, on how much amount TDS should be deducted, that depends upon how the invoice is formed by you. If you form a consolidated invoice of labor and material both together, then I will deduct TDS on the entire amount. But if you give the breakup, then I will deduct TDS only on the service portion. But unfortunately, you have given a consolidated invoice. Therefore, I will deduct TDS on the entire amount over here of entire 40 lakh rupees. I hope it is clear to all of you. And the last one is a very simple question on TDS. There is a there is a non-resident and a Canadian citizen, a sportsman who is coming to India for playing some matches. That will be taxable under 115 BBA. TDS will be deducted under 194E at 20% plus 4% cess. Plus, he is also contributing some article in a sports magazine. That is also taxable at 20% plus 4% cess. I hope it is clear to all of you. Now, the next question is also a beautiful question of transfer pricing, which is on cost plus method. Now, what happens in cost plus method? The step number 1 in cost plus method is when you provide services to your associate enterprise, what is your direct and indirect cost? And then you have to find out the arm's length margin. Whatever is the arm's length margin, that you will apply on what? Apply on your cost, and then you will get the arm's length price. Now, first of all, let us try to understand the relationship between different people over here. MNO Limited is in India and MNO INC is a subsidiary company. Therefore, both of them are what? Associate enterprise. There is also another company, HTY Limited, which is the third party, okay, with whom we are going to compare the transactions. I hope it is clear to all of you. Now, the billing per month to MNO is $85,000 and billing per month to third party is $92,000. And the cost is given in point number 4 and point number 5. First of all, step number one, what is the cost to associate enterprise? The cost to associate enterprise is very simple. We provide services of at the rate of the direct cost is $120 and indirect cost is $210 per hour. Okay, per hour it is $120 and $210 per hour. Now, MNO provides services to MNC, MNO provide to MNO INC for 9 hours per day for 18 days. So $330 is the total cost. Direct and indirect cost 220 plus 120 into 9 hours per day. We provide services to whom? MNO INC, to our associate enterprise, and we provide that for 18 days. Therefore, our cost is 53,460. This is how I will determine my cost. Okay. Now I need to find out the arm's length margin. For that, I want the cost and the sales and the profit of HTY Limited. So for HTY, you provide services for 18 days, but only 8 hours. Okay. You provide services for 18 days for only 8 hours. So I'm finding the GP margin of HTY. For HTY, the direct cost is 120 into 8 into 18 days. Indirect cost is 210 into 8 into 18 days. This is my total cost. Okay. But unfortunately, this is not my total cost. There is one more cost when I provide services to HTY. That is, I provide warranty of 2 years to HTY. Okay. I provide warranty of 2 years to HTY, which amounts to 1.5% of the direct cost. Will I not include that also in my cost? Definitely I will include that also in my cost. So I'm providing the warranty, which is 1.5% of my direct cost. Therefore, that also I will add to my cost. That will make my cost 47,779.20. This is my total cost. Okay. When I provide services to HTY, what is my billing to HTY? My billings to HTY is 92,000. Therefore, this is my profit. Therefore, my arm's length margin to HTY. When I provide services to HTY, my margin is 92.55%. Now coming to my cost. Is my cost 53,460? No. I have one additional cost. What is that additional cost? I take a loan from MNO. When I take a loan from MNO, I have to pay interest to MNO. How much loan I have taken? $1,20,000 I have taken into 4% into 1 by 12. 1 by 12, why sir? Every data over here is monthly. Therefore, I am taking 1 by 12. Therefore, my total cost is how much? My total cost is not 53,460. This is my direct and indirect cost. Apart from that, I am also taking loan from MNO INC. That is also my additional cost. So that I have to add. Once I add that, I will get my total cost. And then I will apply this arm's length margin to my cost, and then I will get the arm's length price over here. I hope it is clear to all of you. Now let's move on to the next question. The next question is on case law. The first question over here is on Pepsi Foods Limited case law, which is on the power of tribunal. Remember, when a tribunal passes an order, what is the time limit to pass an order by a tribunal? It is generally 4 years from the end of the financial year in which the order was received, in which the appeal was filed. Okay, tribunal has to file the pass an order within 4 years. But in some cases, tribunal has to pass the order within 180 days. When the assessee has asked for a stay, if the assessee has asked for a stay, then the tribunal should pass an order within 180 days. Can it be extended beyond 180 days? Now listen carefully. Yes, it can be extended beyond 180 days up to 365 days if there is a mistake of tribunal. If there is a mistake of tribunal, it can be extended. If there is a mistake of assessee, it cannot be extended. If the delay is because of tribunal, then the tribunal has to extend. What about after 365 days? After 365 days, income tax law says that it cannot be extended because of anybody's reason. Even if it is assessee's mistake or tribunal mistake, if the delay is attributable to assessee or if the delay is attributable to the tribunal, it cannot be extended beyond 365 days. Here came the Supreme Court of India in the case of Pepsi Foods India Limited. The Pepsi Foods India Limited Supreme Court said that no. Even after 365, if the delay is attributable to the tribunal has to extend the time period and has to extend the stay, has to extend the appeal period. Okay, this is what this case law wants to say. Ultimately, this case law wants to say the tribunal has to extend the period beyond 365 days if it is because of their mistake. Okay, next one, the assessee search was happened on assessee's premises on 31st of December. His business premise was searched, his residential premise was searched, and some gold bar was seized by the income tax department. Okay, now generally there is a proviso under section 132B which says that if the department has seized anything in search and seizure, then you have to go to the department within 30 days from the end of the month in which the search was done. So within 30 days of the end of the month in which the search was done, you can go to the department, you can explain the nature and the source of that particular gold which is seized, and then the department will do what? Department will reduce their existing tax liability and will give you the balance amount. Okay, now that 30 days period is gone. After that, few months after that, the assessee is going to department and saying that I am telling you my rough tax liability, this much will be my rough tax liability, this much will be my estimated tax liability, and take that much the gold from that and give me the remaining gold. Will the department do that? And the answer is no. Now the department will not do anything till the time the assessment is not completed. Once the assessment is completed, they will determine the tax liability, they will recover from the gold, and balance they will give you. They will not give you anything before that. You had a time of 30 days from the end of the month in which the search was conducted. That is gone now. Now you cannot come voluntarily in between and determine your tax liability. Estimated tax liability will come to this much. You have to wait for the final order to pass. Okay, I hope it is clear to all of you. The next question, you need to identify whether the following statements are correct or not. There is a person, Mr. Ricky, a resident. It is aggrieved by the order of the board for advance ruling. Now, if you are aggrieved by the board for advance ruling order, what is the remedy available with you? You have to appeal to High Court within 60 days on the date of receipt of the order. So, whenever you receive the order, within 60 days on the date of that day, you have to go to appeal to the High Court, and the High Court might give you some kind of relief. Second question over here is, there is an Indian public sector company, whose matter is already pending before ITAT. They want to ask whether they can go for board for advance ruling or not. Now, generally, if the matter is pending in front of any authority, you cannot go for board for advance ruling. But for public sector company, there is a relaxation that if their matter is pending before ITAT or income tax authority, then also they can go for what? Board for advance ruling. If that matter is pending in front of ITAT and income tax authority, they can go for board for advance ruling. But if that matter is pending before High Court and Supreme Court, they cannot go for board for advance ruling. The next question is a very simple question of 2020 equalization levy. There is a non-resident, count the conditions with me. There is a non-resident who does not have a P in India. The turnover of that non-resident from India is more than or equal to 2 crore rupees, and that non-resident is providing online some services, online shopping services. Therefore, 2020 equalization levy is applicable. Why it is applicable? Because the goods are sold to residents in India or goods are sold to person residents in India. Those are covered, and the total turnover is also 2 crore or more than that. Therefore, 2020 equalization levy is applicable. It's a very simple question of equalization levy. We have done much better question than this earlier. Okay. Now, there are 4 parts over here which ask us the following question: whether GAR will be applicable in these cases or not. First of all, an Indian company is making losses, therefore it gets amalgamated with another company. Whether GAR will apply? Why GAR will apply? It is a tax planning. If there are losses, you are getting amalgamated with another company to transfer the losses. It is allowed. It is allowed as per code also. It is allowed as per the income tax law also. Therefore, GAR will not apply. Okay. In second case, you have to make one change. You have to just change this to 2016 rather than 2018. Okay. Otherwise, the entire answer will change. The SSC has purchased some shares of a company listed since 2016. Okay. Then there are some mistakes which are done by SSC. SSC trying to do some manipulation in the law, and therefore whether GAR will apply or not, GAR will not apply. The simple logic over here is GAR is applicable only if the transaction is entered on or after 1st April 2017. Any transaction entered before 1st April 2017, GAR will not be applicable in that case. Therefore, in this case, GAR is not applicable. Okay. In third case, a company is there in India. It deliberately forms a subsidiary company in country B, and then through that it gives loan to what? C Limited, rather than directly giving loan to C Limited. A can directly give loan to C Limited in India, but they are making one subsidiary in country B, and that country B is giving loan to a C Limited. This is the proper case of GAR. You are trying to avoid tax by playing with the words of the law. Therefore, GAR will apply in this case. In fourth case, very simple. You are setting up a unit in SEZ, therefore to claim 100% deduction. Therefore, GAR will not apply. It is a case of tax planning. In case of tax planning, GAR will not apply under the income tax law. Okay. And one last question over here is who can be called as an agent of a non-resident in India? Who can be called as an agent of a non-resident in India? For that, let's see the provision of section 163. 163 says that if a non-resident has employed any person in India, any person is employed in India on behalf of non-resident in the current year, then that person can be agent. Or if non-resident sells any asset to another resident or non-resident in India. So if non-resident sells any assets to any resident in India or sells any assets to any non-resident in India, then it can be called as an agent of non-resident. Okay. In first case, Mr. Albert is a non-resident. Now, Mr. Albert has a house in Goa. Now, during the financial year, he has sold that house to another non-resident, Mr. D'Souza. Whether Mr. D'Souza can be called as his agent? The answer is yes. If a non-resident sells transfer capital asset to another non-resident in India, then it can be called as what? That purchaser will be called as an agent of that non-resident. Okay. Second, Mr. Albert has employed Mr. Rakesh in 2022, but in 2023, Rakesh left the company and went away. Whether Rakesh can be called as an agent of Mr. Albert? The answer is no, because Rakesh is not an employee of Albert in the current year. If he would have been employee of Rakesh, if Rakesh would have been employee of Albert in the current year, then he could have been called as what? As an agent of Mr. Albert. In this case, it is not called because he has left the company. So this is what this paper is all about. So let us start with the first question of May 2023 paper. It's a long paper. It will take some time to discuss this paper, but nevertheless, we'll try to complete as fast as possible. First of all, the question number 1 is on total income. The SSC is a manufacturer, and therefore, we need to see if 115BAA or BAB is applicable. No, we are not supposed to follow 115BAA and BAB. You are supposed to just compute total income as per the normal provision. Okay. Therefore, the very first adjustment is you are paying some excess amount to your sister concern, and the fair market value is only 52,000, but you are paying 1,60,000 in cash. So you are doing violation of 48(2) also,
and you are doing violation of 48.3 also. So first of all, I have also always told you this in class that if the provisions of 48.2 as well as 48.3 both of them are violated, then you have to apply first 48.2. Therefore apply 48.2 and disallow the excess amount, and then apply 48.3 and disallow what? The excess amount of, if the balance amount is more than 10,000 rupees. Okay, so first of all disallow 48.2, and then if the balance is more than 10,000 you have to disallow 48.3. Okay, next, there are some repairs which you are doing for plant and machinery for replacing the worn out parts of the machinery. So will that be allowed as a revenue expenditure under section 31? Yes, it is allowed as a revenue expenditure because this does not bring any existence of any new asset. If you do such a repair which is leading to a new asset, which brings existence of new asset, then in that case it is not allowed as a deduction. Okay, next one, till last year the company used to include interest as a part of its stock, but from this year onwards they have changed this particular thing and they have excluded interest from the stock valuation, opening and closing stock. So actually speaking, you should not include interest as a part of your stock. Interest should never form part of the stock. So in the current year the company is doing the things correctly, and they have given the effect also of that particular thing in the P&L account. So if everything is done correctly, why we have to do anything effect over here? Why will we give any effect over here? Because the company is correcting its mistake in the current year, and they are reflecting that particular thing in the P&L account also. Therefore there is no need to do anything over here. There is one of the employee of the company, that is one executive of the company, who went on a business trip and he died because of some reason on a business trip, and therefore the company, as a measure of humanitarian ground, the company is helping his family by paying some voluntary amount to his family. Therefore that will be allowed as a business expense under section 37(1) because the employee was on business trip. Okay, next one, there is some capital expenditure of family planning which is incurred by the company. Therefore capital expenditure of family planning is only allowed 1/5. Therefore 4/5 will be added back to the PGBP income. Okay, next one, there is some retrenchment compensation which are paid to some of the employees for closing down of one of the unit of the company. So that is allowed as a PGBP expense under section 37(1). Don't worry about it. Okay, next one is a very intelligent point. There is a cooperative bank. Okay, there is a cooperative bank from whom we have taken some loan. Now that bank is waiving that loan for me. I have taken that loan for what purpose? You have taken that loan for working capital requirement. So I have taken a loan of 4 lakh rupees from a cooperative bank for working capital requirement. Now bank is waiving that loan. Now this will be deemed income under section 41 subsection 1. Why? Because it is a remission and cessation of a trading liability, because I am taking the loan for working capital purpose. Therefore it is deemed income. Now apart from that, they are also waiving interest of 1 lakh rupees which is outstanding. Now this will not be taxable. Why? This will not be taxable. Why? Because this 1 lakh rupees, was it allowed as a deduction earlier? The answer is no, because as per 43B, this 1 lakh rupees will be allowed as an expense under PGBP only if it is paid, and this was not paid because it is outstanding. Therefore when it is waived off, it cannot be taxable, because when it was accrued, it was not allowed as deduction. So when it was waived out, at that time also it should not be taxable. Therefore you will remove this 1 lakh rupees from your PGBP income. Okay, next one, you are contributing some, the employer is contributing some amount to the employee's pension scheme. Now that is allowed as a PGBP expense, but only to the extent of 10% of the salary. Salary means basic plus DA in terms. Therefore here you are paying 12% of the salary, you will not be allowed 12%, you will be only allowed 10%. Therefore 2% will be disallowed. 2% will come to how much? 50,000 rupees if you make a backward calculation. Next one, mark to market loss is allowed as a deduction provided it is computed as per ICDS. Now ICDS says that if you incur mark to market loss for unsettled derivative contract, it is not allowed. Therefore, because ICDS 1 says that unsettled derivative contract is not allowed as a deduction as per ICDS, therefore this mark to market loss will be disallowed under the income tax law. Next one is a very routine adjustment whereby the actuarial valuation is 4 lakh rupees. So the provision for a gratuity will be added back, and the actual gratuity which is paid to the employee will be allowed as a deduction under PGBP. Next one is also a very simple adjustment. There is a company in which another company has 16% voting rights. That is, one company holds more than or equal to 10% of the voting rights of the other company, and both the companies are closely held company. So if I invest in a closely held company, and if I receive what? If I receive a loan from that closely held company, then in that case it is deemed dividend under section 222E. But the deemed dividend cannot exceed how much? The accumulated profits. Therefore, even though I am receiving loan of 4 lakh rupees, my deemed dividend cannot exceed how much? 1 lakh. Therefore, deemed dividend will be how much? 1 lakh rupees. Next, I am giving some benefit or perquisites to some of my customers or to some of my distributors, so on and so forth, as a matter of what? Business promotion expenses. Therefore, what I am giving? I am giving some phones. I am giving 5 sets of phone to 5. I am giving phones to 5 different distributors, and each of them costing 60,000 rupees. Therefore, total perquisites and benefit which I am giving is around 3 lakh rupees. Now, on that I should have deducted TDS under section 194R at the rate of 10%, a very recent amendment. But I have not deducted the TDS as it is written in the question. Therefore, 30% of this 3 lakh rupees will be disallowed under the PGBP for not not deducting the TDS. Okay. Last but not least, I'm making some payment of what? A donation to certain electoral trust which is made by RTGS, and therefore it will be allowed as a deduction under 80 GGB. You can check it over here. So it was a simple question except one or two adjustments which was slightly tricky. Apart from that, most of the things were very simple in this question. Now pay attention please. Let's move on to the next question. The next question is also very simple question. Mr. A is aged 34 years. He is a salaried employee. Okay. Now, he is earning a salary of 23 lakhs. So, from that, first of all, he will get 50,000 standard deduction because he is not following 115 BSc. You can check it over here. Now, he has a business loss of 4,50,000 that he cannot set off against this. Therefore, he has to carry forward. He has a capital gain loss of 3,60,000 that also he cannot set off against salary. Therefore, he has to carry forward. Apart from that, he is also selling some bitcoins, or you can say virtual digital asset. Therefore, the selling price of virtual digital asset is 1,300 and the cost of the virtual digital asset is 1,000. So, 300 rupees is the profit multiplied by 1,000 quantity. No deduction of transfer expenses is allowed for virtual digital asset as per section 115. Therefore, here you are not going to get what? Any deduction of what? Virtual digital expenses on transfer. Only cost of acquisition is allowed. Therefore, 1,300 minus 1,300 is directly taxable at 30%. Sir, can I set off these losses against this income? Not allowed, not allowed, not allowed. That is directly taxable at 30%. These losses you cannot set off against salary also. These losses you cannot set off against the Bitcoin income also. Both of them have to be directly paid as a tax. Okay, just check it once. Let's move on to the next question. The next question is on section 9B and section 45.4, both of them combined together. There are three partners, L, M and N, and one of the partner, that is L, is retiring on 27th of July, and when he is retiring, his capital account is showing a balance of 20 lakh. There is no revaluation of asset in the books of accounts at any time when the L joined as a partner. Okay. Now, what is L getting on retirement? L is getting some cash payment of 1 lakh, some stock in trade, and then he is also getting some land at quota. Okay. Now, first of all, we'll apply section 9B. When is 9B applicable? 9B is applicable if the firm gives to partner stock in trade, or if the firm gives to partner what? A capital asset. Okay. So, first of all, the firm is giving to partner stock in trade. The stock in trade is how much? The value of the stock in trade is 2 lakh. You have to take the fair market value of the stock in trade, compare with the cost of the stock in trade, which is 1,20,000. Therefore, 80,000 will be what? The PGBP income, which will be subject to 31.2% tax in the hands of the firm. Okay, be very careful. The second thing is, which the firm is giving to the partner as an asset, is a capital asset, land at quota. Now, the FMV of the land, the FMV of the land is 17 lakhs. So you will take that as a sale consideration. Then the cost will be the actual cost, or FMV as on 1/4/2001, whichever is higher. Therefore, you will take whichever is higher multiplied by current year indexation divided by 100. That comes to 13,35,900. And this is long term, and on long term capital gains, you are going to pay 20.8% tax. So these are the two taxes which you are going to pay under what? Under section 9B, one for stock in trade, one for capital gains. Now coming to what? 45.4. What is 45.4? 45.4 speaks about reconstitution of the firm, and it is applicable if the partnership firm give to the partner money or capital asset. Therefore, B is money, C is capital asset, and D is the capital account of the retired partner. So, B is money. How much money the firm is giving? The firm is giving 1 lakh rupees. Therefore, you will take 1 lakh in B. C is the fair market value of the asset which is received by the partner. Therefore, how much is the capital asset which is received by the partner? Only capital asset is covered in what? Now, 45.4. 45.4 does not talk about what? Stock in trade. Therefore, here you are going to take 17 lakh as its what? Capital asset. Now, what is D? Now, the most important point over here is D. Before computing D, whatever profit you have earned, whatever book profit you have earned under 9B, you have to allocate that book profit after tax to all the partners. That is a very important step that you are not going to forget. Okay. First of all, what is the book profit? What is the accounting profit on transfer of land? Now, the transfer of land, there will be no accounting profit because the land in the books was 17 lakhs and the land market value was also 17 lakhs. Therefore, there will be no profit in the accounts on land, but there will be a profit on SIT in the books of accounts. How much? The SIT was 1.2 lakhs. It was recorded at cost of 1.2 lakhs. But when you transfer, you are transferring at 2 lakh rupees. Therefore, there is an accounting profit of 80,000 rupees in your books of accounts. Therefore, your accounting profit is increasing by 80,000. But at the same time, you are paying two taxes. One is on this 80,000, you are paying 31.2% tax as per 9B. So that you will take 24,960. And another, you are paying 20% tax over here on the capital gains of that quota land. That you will minus this. After I do this, I will get a loss over here instead of profit. So you will divide this loss between all of them in equal share, assuming that the share of profit of all the partners are equal. In the question, the share of profit is missing. So you can assume that all the partners are having equal share. Therefore, 74,276 goes to this retiring partner. What is the capital account of this retiring partner? 20 lakhs. What is the share he is getting? Loss of 74,276. So I will reduce this, I will get D, and then I will get the capital gains, which is chargeable under what? Under section 45(4). It's a very, very, very intelligent question. Next question is a very, very simple question. It's a repetitive question which has come many times in the exam, which we have done earlier also in a lot of papers. That is, there is a foreign company which is entering into an agreement with an Indian company to provide some assistance with respect to a power plant in Gujarat. What kind of assistance? They are providing some FTS services to Indian entity. FTS services, one is offshore service, another is onshore service. Offshore means they are providing the services from outside India with respect to Indian project. Onshore service means they are coming to India and providing services in India. It doesn't matter, yeah. In case of FTS, FTS is deemed to accrue or arise as per 917, whether or not you provide the services in India. It doesn't matter. Whether or not you provide, whether you have a business connection in India, it doesn't matter. The question is saying that foreign company does not have a business connection. It is not required for FTS. For FTS, for interest, for royalty, all these things are not relevant. Only thing is relevant is that services has to be utilized in India. Therefore, this 2 crore will also be taxable. This 3 crore will also be taxable. Now, how the consideration is discharged? This 3 crore is discharged to the other person through a bank account. Therefore, this 3 crore will be taxable as per 917. It is deemed to accrue or rise in India. How this 2 crore is discharged? This 2 crore is not discharged in monetary terms. In fact, we are giving them debentures worth rupees 2 crore. Therefore, that will also be taxable. We have done similar adjustments earlier also. Okay. Now, there is one hidden adjustment over here. On this 2 crore rupees, now the foreign company will also earn interest for 7 months. From September to March, they will also earn interest. Now, that interest will also be what? Deemed to accrue or rise in India. And you have to take that interest also in India and you have to pay tax on that also. Check it, please. Now, let's talk about the next question. Question number 3 is part 1. Now, this is the first question which is on charitable trust. There is a charitable trust who are giving some interest-free loans to employees. Now, the question is, if a charitable trust gives some interest-free loans to the employees, are employees covered in the specified person mentioned under 13(3)? The answer is no. A specified person does not include employees. It does not include relatives of the employees. It does not include all these people. It includes author of the trust, founder of the trust, substantial contributor, etc., etc. These people are covered in what? In specified person. Therefore, if the trust is giving some interest-free loan to employees, it is not a violation of the provisions of the trust and the AO cannot withdraw the exemptions of the trust. Okay, check it, please. Next one is a very routine question which we have done so many times in our discussion. That is, there is one educational institution and there is one hospital. The annual receipt of educational institution is 2.4 crore and annual receipts of hospital is 2.5 crore. The aggregate receipt does not exceed 5 crore rupees. Therefore, there is no need to take any kind of approval for the purpose of claiming exemption. If the annual receipts, aggregate annual receipts is up to 5 crore rupees, there is no need to take what? Any kind of approval for the purpose of claiming exemption. Okay. Now, the next question is a very, very intelligent question. And in this question, you have to make some assumptions now. There are 2 assumptions that you are making. According to that, the answers will change drastically. The first assumption which we are making that this person is coming to India on 1st July 2022 permanently. Now, he is a resident. Definitely, if he is coming in July, he is a resident because from July to March, he will be staying for 182 days. But we don't have the data of the past year. Assuming that in the past years also, he has come to India and his stay in the last 10 years, in the last 7 years is 730 days. And out of the last 10 years, he is resident in at least 2 years. Therefore, we can make an assumption that he is a resident and ordinary resident. Let us answer according to that first. If a resident and ordinary resident, then world income will be taxable. First of all, his salary income of the first 3 months. First 3 months, he was staying outside India. April, May, June, he was staying outside India. From 1st July, he came to India. Because of his mother who was not well, so he came to India. He planned to shift it to India. Okay. Now, if he is resident and ordinary resident, then world income is taxable. This 3 month salary will be taxable. Yes, it is taxable. So 3 month salary 3250 into whatever is the average rate, 23 rupees will be converted. Okay. Then he has also rented some house property over there from July. From July, he has property was rented. So his rental income will also come over here. So his salary is 9500. Sorry, his rental is 3250. On that rental, he will get deduction of standard deduction of 30% also. Apart from that, profit from business will come. A bank interest come from country S, that will also come in the income statement. Income from saving bank interest from SBI will come in the income statement. Then dividend income from India. These are all income which are accrued in India. All these things you will do. After that, you will also take chapter 60 deduction. 25,000 mediclaim you will take under 80D for himself because he is not a senior citizen. And for his parent also, he will take only 25,000 because his parent is non-resident. Okay. If parent would have been resident, he would have taken 50,000 rupees. Because the parent is resident, non-resident, sorry, therefore he will get only 25,000 rupees. After doing that, he will also take deduction of 80 TTA, 10,000 rupees. And then he will compute the average tax rate in India. And then he will compare with the average tax rate of foreign country, whichever is lower, that much will be allowed as a relief. Now, another assumption which we can make is he is a resident. He is definitely a resident. There is no doubt about his residential status. He is definitely a resident. But the question is, we don't have the data of the past year. So we are assuming that he is resident, but he is not ordinary resident. If he is resident, but he is not ordinary resident, then all his income cannot be subject to tax in India. Then which income will not be subject to tax in India? The income which is accrued outside India, that is salary income, will not be subject to tax. HP income will not be subject to tax. And similarly, this FD income outside India will also not be subject to tax in India because these incomes are accrued outside India. In case of NOR, only incomes which are accrued or deemed to accrue or receive or deemed to receive in India are taxable. Or if the PGBP is done outside India and controlled from India, then only it is taxable. Otherwise, foreign incomes are not taxable in case of what? NOR. Accordingly, both the solutions are correct. Whatever solutions you will feel correct, you can do. You are not supposed to do both of them. Anyways, you don't have that much time in exam to complete the paper. Okay. Now, next question, we'll go ahead. Which is question number 4, which is on TDS. Now, it's a very good question. We have done this question earlier also. Mr. A is purchasing some scrap. Now, if you are purchasing some scrap, the seller will collect TCS. But if you give a declaration that I'm going to use this scrap for the purpose of what? Manufacturing or power generation, the seller will not collect TCS. So, you are giving an excuse that I'm going to use this scrap for what purpose? For manufacturing purpose. Therefore, here in this case, the TCS will not be collected. But you are exempted from TCS. The seller is exempted from TCS. But is the buyer liable for TDS under 194Q if the last year business turnover is greater than 10 crore? And Mr. A's last year business turnover is greater than 10 crore. Therefore, buyer will be liable for what? The TDS under 194Q because the sale purchase is also exceeding what? 50 lakh rupees. Okay. So, on 5 lakh rupees, 0.1% TDS will be deducted by the buyer. TCS is exempted, but TDS will not be exempted. If TCS would have not been exempted, then TDS would have not been applicable. But if TCS is exempted, you have to deduct TDS under 194Q. There is a CBDT circular on the same, okay, which we have done it in class. Next is, there is one person, Mr. P, who is providing some services to client, technical service, and on technical service, we know that we need to deduct TDS at the rate of 2% under 194J. But the client is giving a certificate under 197, lower deduction certificate, and saying that please deduct 1%. So I said that yes, I will deduct 1%. But unfortunately, later on, I came to know that the assessee is not filing the return of the last 2 years. And the assessee's TDS is also more than 1 lakh rupees. Now, do you remember that? If the payee is not filing the return for the last 2 years and the payee's TDS is also 50,000 rupees or more, then in that case, I am liable to deduct TDS as per 206 AB. Now, what does 206 AB says? 206 AB says that twice the rate or 5%, whichever is higher. Now, what is the rate over here? The rate is the concession rate is 1%. Twice of that will come to 2%. Compared with 5%, whichever is higher, will be liable for deduction at TDS. Therefore, I will deduct TDS at how much percentage? I will deduct TDS at 5%. It's a very intelligent question. Now, the third question is a very simple question. You are buying some house property. The price of the house property is 60 lakhs, whereas the stamp duty value of the house property is 82 lakhs. Therefore, TDS will be deducted at the rate of 1% on how much? On 82 lakh rupees. Check it, please. Okay. So, this is what this question is all about. Now, the next question is a transfer pricing question. It's an easy question, nothing great as such. There is a domestic company and there is a foreign company, CMA Inc. Both of them are associate enterprise. Sir, how did you come to know that both of them are associate enterprise? One entity is wholly dependent on the raw material of another entity. Now, if one entity is dependent on the raw material of another entity for 90% or more, if I am dependent on you for 90% or more of the raw material, then we both are what? Associate enterprise. Therefore, both of them are associate enterprise. Now, Shahi Private Limited is purchasing some goods of 30 crore rupees from its associate enterprise. Now, we need to find out the arm's length price of this 30 crore. Now, Sumi is charging us 20% margin, whereas Sumi is charging other unrelated party only 10%. So, they should charge us also 10%. Okay. So, what I am doing? First of all, I am removing the margin of 20%. I am removing the margin of 20% on cost. So, if it is 20% on cost, therefore, it is 1/6 on sales. So, I am removing 5 crore rupees or 5 lakh rupees, whatever it is from here. If I remove the margin, 20%, my margin, then I will get my cost. Then I will add what? Add the margin, which is arm's length margin. The arm's length margin is 10%, so I am adding 10%. Okay. So, first of all, I am removing the entire margin, making it at cost, and then I am adding what? The genuine margin. The genuine margin is 10%, so I will get the actual price. Okay. After that, the Sumi is also providing me some additional services for which the Sumi is allowing me to use the brand name of Sumi Inc. So, for that, Sumi will charge me extra amount here. How much extra they are charging? They are extra charging 0.9 crores, that is 90 lakhs. So, I will add that also to my cost. Therefore, effectively, my cost will come to how much? My arm's length price will come to 28.4. Whereas, I am purchasing at how much? At 30 lakh rupees. So, I am paying extra 1.6 lakhs. This will be added back to the income statement. Okay. Now, the second question. If the TPO enhance the income, by 2 crore rupees, can I claim deduction of 10AA on that 2 crore rupees? No, not allowed. As per first proviso to section 92C subsection 4, if the assessing officer increases or the TPO increases your income, then on that increased income, you are not eligible to claim 10AA or chapter 6A deduction. You are not allowed to do that. Okay. Next, if there is an underreporting of income because of the transfer pricing officer, will I be liable for penalty? Yes. If you do not report your income properly in the income statement, then the TPO will impose what? The TPO will impose 270A penalty, that is misreporting. 200% penalty will be imposed on the assessee. Okay. So, this is what this question is all about. Next question is on case law. There are 3 case laws over here. which I will address you one by one, all of them. There was an assessee on which there was some genuine hardship because his money was stuck with debtors. His large funds were stuck with debtors, and some of the funds were also stuck with the income tax department in the form of refund. Now, what mistake assessee did? Assessee, while making the payment to one of the party, deducted the TDS but did not pay the TDS on time. But assessee, after some time, deliberately paid the TDS along with the interest before he received the notice from the income tax department. So, assessee has done everything correct before receiving the notice. Is it justified to put the assessee under jail? Is it justified to put prosecution proceedings on the assessee? And the court said that the answer is no. There was a genuine reason for not paying the TDS on time because the assessee's funds were stuck. The assessee's funds were stuck with the debtors, stuck with the income tax department, and assessee has paid the tax before the department sent the notice. Assessee has so much to pay the interest also before the department sent them the notice. Therefore, there is no reason to charge what? Prosecution proceedings on the assessee. Okay. Next question is on Reliance Telecom Limited, whereby the powers of the tribunal order is discussed over here. Does tribunal has the power to, after passing the order, to call back the order and re-hear the entire order? The answer is no. The tribunal does not have the power to call back the order and re-hear the entire order. The tribunal has the power, only power, to bring the order, to call back the order and rectify an apparent mistake if there is an apparent mistake within the time limit. That too within the time limit. The tribunal cannot bring back the order, call back the order and re-hear the entire appeal once again by reconsidering the entire matter once again. That is not possible. Okay. Next, last but not least, there was an assessee on whom there was some MAP proceedings which were pending. What is MAP proceeding? MAP is a mutual agreement procedure which is pending at international level between two countries. Now, because the MAP proceeding is pending, the assessee is saying that the department should waive my interest. Waive my interest under section 220A. Is it justified to waive the interest under 220A just because a MAP proceeding is pending at international level? The court has said in the case of Pioneer Incorporation, USA, that it is not justified to waive your interest under 220A just because a MAP proceeding is pending against you. Just because a MAP proceeding is pending, that does not give you the right to tell the department that waive my what? Interest. That is absolutely a bullshit point, because then everybody will do what? Everybody will initiate a MAP proceeding with higher authority, with international authority. And once you initiate that, deliberately you will initiate that MAP proceeding. Once you do that, then the department will be forced to what? Forced to waive the interest. Everybody will use this as a tool. Therefore, the department said that that is not allowed. The court said that that is not allowed. Okay. Now, the next question is a very intelligent question where ICI has again taken two different alternatives. First of all, they are solving this question as per equalization levy. Secondly, they are solving this question as per income tax act. Sir, which one is correct according to you? According to me, the second one is correct, because the question is very clear, which is saying that you should solve as per income tax act, not as per equalization levy. Okay. But they have done it as per both the cases. Now, there is one company, Kiwi Inc., which is a company which is based in USA. They are engaged in manufacturing and selling of mobile phones globally. There is another company, Alpha Inc., which is engaged in managing a website. It is working like Amazon. Okay, they are also engaged in hosting advertisement. There is another company, Gamma LLC, which is incorporated in UK, and they are engaged in manufacturing and selling printers. Now, we are talking about Kiwi Inc. First of all, Kiwi Inc. is selling 80,000 mobile phones. So, first of all, I am discussing the point as per equalization levy, the way ICI has done. Now, in first case, equalization levy is applicable because you are selling to persons resident in India. Therefore, 2% equalization levy will be applicable as per Finance Act 2020. 15,000 into $2,000 into 80 rupees is the price of dollar over here. You have to multiply that. If this amount is exceeding 2 crore rupees, equalization levy is applicable, and it is exceeding 2 crore, you can check it over there. Okay. Second thing, in second case, equalization levy will not apply because you are not selling to persons resident in India. The primary condition is that you should either sell to person resident in India, or to person non-resident in India in certain specified circumstance, or to any other person using IP address in India. These are the three circumstances in which equalization levy of 2020 is applicable. In third case also, equalization levy will be applicable because you are again selling to the resident of India, and if you multiply 7,000 into 2,000 into 80, you will get more than 2 crore rupees. Therefore, again equalization levy is applicable. In the fourth case, it is not applicable because again you are not selling to the residents in India. You are selling to the residents in UK. In the fifth case also, it is not applicable because the sale itself is done outside India, because the physical store is outside India. The physical store is not in India. The sale is done outside India. Okay. Apart from that, there are two more transactions which are over here which we need to talk about. First is there is some transaction of 50,000 rupees which you have paid for hosting advertisement for targeting Indian customers. Is this covered in 2016 equalization levy? 2016 equalization levy will not apply. The reason is very simple. Because for 2016 equalization levy to apply, the payer who is in India has to be resident or a non-resident who should have a P in India. Either of the two has to be there in India. Here, the person who is paying the amount is not a non-resident who is having a P in India. The person who is paying the amount does not have a P in India. Therefore, 2016 equalization levy is not applicable. 2020 equalization levy will be applicable. The reason is because they are targeting the Indian customer. In second case, even 2020 equalization levy will not be applicable because there they are targeting the UK customer. If you are targeting UK customer, equalization levy cannot be made applicable. This is the one of the way to solve this question. Another way in which institute has solved this question is by considering this as what? As a business connection. We know that there is an amendment which is made under business connection, which is applicable from AY 22-23, which says that if there is a significant economic presence in India, then it is also what? Subject to business connection and income is deemed to accrue or rise in India. And what is significant economic presence? If a non-resident is entering into a transaction with a resident for sale of goods, for services, for download of data, etc., and the payment is more than 2 crore rupees, then significant economic presence is attracted. So the condition is the non-resident should enter into a transaction with a resident and there has to be a more than 2 crore rupees payment. Therefore, in the first case, there is a significant economic presence because the transaction is with resident and the payment is also more than 2 crore. Significant economic presence is applicable. In second case, it is not applicable because you are entering into a transaction with non-resident. In third case, it is applicable because you are entering into a transaction with resident and there is a more than 2 crore rupees payment. In fourth and fifth case, also not applicable because in fourth case, you are entering into a transaction with non-resident, and in fifth case, you are entering into a transaction which is done outside India that has nothing to do with income which is accrued in India. That is just absolutely done outside a physical store outside India. That is never going to be accrued in India. Okay. Last but not least, do you remember that in business connection also there was one amendment that if there is a sale of advertisement by one person to another person by targeting customers in India, then that is also taxable in India. That is also deemed to accrue as in India. Therefore, this 50,000 will also be deemed to accrue as in India under section 911. But this $20,000 will not be accrued in India because here we are not targeting the Indian customer. Okay. So this is what this question is all about. You can solve by either of the way. You can go through the solution once at your end if you want. Okay. Last but not least, one last question is there over here, which is on SFT. So whether SFT is liable to be filed by the reporting person or not, we need to decide that as per 285BA. One person, Mr. A, is going to a State Bank of India and buying 5 FD of 3 lakh each through his current account. SFT not applicable. Yes, if you buy an FD of more than 10 lakh rupees in cash, then SFT is applicable. Here the person is buying FD bank draft in what? In through current account. Therefore, SFT will not be applicable here. Okay. Next question. There is one person who is going to Canara Bank and buying an FD. Time deposit means FD or RD. Is buying a time deposit of 7 lakh rupees and is renewing a time deposit of 5 lakh rupees. Therefore, SFT is not applicable. Why, sir? What is the provision? The provision says that if any person goes to a bank and buys a fixed deposit, recurring deposits of more than 10 lakh rupees in a financial year, other than renewal, the renewal point will not come over here. Therefore, other than renewal is how much? Other than renewal is only 7 lakh rupees, which is less than 10 lakh. Therefore, here also the SFT provisions are not applicable by the Canara Bank. Okay. Next one for credit card. For credit card, when credit card companies are liable for SFT, they are liable if the aggregate credit card payment by a person in the entire year is more than what? Is more than 10 lakh. Or if the cash payment in the entire year is more than 1 lakh. Now, in this case, if I do the aggregate cash payment, first and the third transaction, this and this will be multiplied by 4, this will be multiplied by 3 because this is for 4 months, this is for 3 months. So the cash payment is exceeding 1 lakh rupees definitely. So therefore, in the first transaction and the third transaction, I am liable for what? I am liable for the SFT reporting. But for the second transaction, I am not liable because that is made through bank. And if I am making the payment through bank, then the aggregate limit should exceed how much? It should exceed 10 lakh rupees. And that is not exceeding. Therefore, in the second case, there is no reporting requirement. But in the first and the third case, there is a need for reporting. Last but not least, every person who is liable for tax audit and if they receive more than 2 lakh rupees in cash, if I am liable for tax audit and if I receive more than 2 lakh rupees in cash, then I am liable for what? I am liable for what? SFT reporting. But in this case, I am liable for tax audit, but I am receiving exactly 2 lakh rupees in cash. Therefore, in this case, there is no need for what? SFT reporting in my case. After this, whatever question is there, that is a theory question. You can go through it once if you want.
So let's move on with one last paper, that is November 2023 paper, which is there in front of us. Let us go ahead with the first question. The first question is on again a total income question. You are not supposed to follow 115 BAA or BAB. You are supposed to compute total income and tax payable as per the normal provision. Okay. Now let's see the first adjustment over here. Assessee is a manufacturer, so it can have some importance in the question. 79,50,000 is the profit of the assessee. The first adjustment, depreciation add back. Second adjustment, destruction of old machinery, and old machinery has caught fire because of which there is a loss of 25 lakhs. So you have to add it back. That is a capital loss, and you have also received some scrap of 7,80,000. That will also be reduced. This is the similar adjustment we have done earlier also. Okay, so add back the loss and reduce the scrap value. Okay, now income tax assessment has done. You have paid 5,70,000 as tax, which includes surcharge of 60,000 and cess of 24,000. It doesn't matter. Surcharge is also disallowed under income tax law. Cess is also disallowed under income tax law. Therefore, entire income tax law will be disallowed here. Okay. Next, you have received some power subsidy from the central government. It's a revenue subsidy. Therefore, it shall be added to the income statement. You have already credited that to the P&L. Therefore, ignore this particular thing in the adjustment. Okay. Because it is already credited to the P&L, you don't have to consider any effect of that because it is already credited to the P&L. Okay. Next one, you want to carry some business. For that purpose, you have obtained a bank guarantee and you have deposited money in the bank. So, for the purpose of business, you have deposited money in the bank so that you get a bank guarantee from the bank, and on that deposited money, you are earning some interest. So this interest is inextricably linked with the activity of business. Therefore, it will be chargeable under PGBP. Since it is already credited to the P&L, you are going to ignore this over here. Okay. Next, you have purchased some raw material for in-house research and development. Therefore, that will be allowed as reduction. You have also paid GST of 2,75,000 on which ITC is not claimed. Because ITC is not claimed, you have not claimed the benefit under the income in the GST law. Therefore, under the income tax law, you can take the benefit of that as a deduction. If you would have claimed ITC, you would have not got the deduction under PGBP. Okay. Next, there is a Chinese company who does not have a P in India, and you are making some payment of 12 lakh rupees as an online advertisement service. So, if there is a non-resident who does not have a P in India, and if you make a payment of more than 1 lakh rupees for online advertisement service, then it is subject to equalization levy at the rate of 6% as per 2016 equalization levy. But you have not deducted the equalization levy. Therefore, this expenditure of 12 lakh will be disallowed in your hands. Okay. Next one, you are receiving some dividend from a foreign company. So, reduce that from PGBP, show under IFOS. Okay. And then you have also incurred some 15,000 rupees as an expense, which is not in the nature of interest. It is other than interest. So, disallow under PGBP, and under IFOS, you cannot get the deduction because in IFOS, you get the deduction of only interest expense from dividend income, that to up to 20% of total dividend. And this is not interest. Therefore, you cannot get a deduction of this 15,000. So, disallow in PGBP, do not reduce from IFOS. One important point that I would like to say over here, generally when the word received is written, we try to gross up that with TDS. Okay. But ICI is following a trend. I don't know why they are following a trend. They are following a trend for the purpose of ease, I guess, for the purpose of easiness, I guess. The trend which ICI is following over here is whenever the dividend is received from foreign company, they are not grossing up. When the dividend is received from Indian company, they are grossing up. So be very careful. When you receive dividend from foreign company, don't gross up. Okay. Next one, you are making some payment of interest by settling the interest by issuing debentures. Can it amount to actual payment? No. Conversion of outstanding interest into a new loan or into a new debenture or into a new security or new bond does not amount to actual payment as per 43B. Therefore, it will be disallowed under the income tax law. After this, depreciation will be taken as a deduction. This is as per income tax. Air compressor which you are purchasing on 1st of May, you will claim 15% normal depreciation and 20% additional because as the CA manufacturer. Air pollution control equipment, 40% normal depreciation, 20% additional depreciation because again as the CA manufacturer. Now purchases after 30th October will be subject to 50% depreciation. Transportation for lorries for transporting goods, 95 lakhs, 7.5% depreciation. Why 7.5? Less than 180 days. Why not additional depreciation? Additional depreciation is not available on motor vehicle. Okay. Then a machinery is purchased which is installed in the next year. So because it is installed in the next year, you will not get the depreciation in the current year. Now the turnover of the company for last year is 415 crore. Therefore, the tax rate of the company will be 30%, not 25%. Then you apply the surcharge if surcharge is applicable and cess and whatever is there, that will be your total income and tax. Okay. Now coming to the next question number 2, which is a question on minimum alternate tax. In this question, we are supposed to compute the book profit first and then we are supposed to compute the minimum alternate tax. Let's see what is the net profit of the company. It is 89. And then there are some items which are debited to P&L and some items which are credited to P&L. We need to find out the book profit and after that we need to find out what? The income tax as per the 115JB, that is a MAT. Okay. Now the expenditure in relation to 10AA, it is not added back in MAT. Okay. Depreciation, you have to add it back and then you reduce the depreciation other than revaluation. In this question, there is no revaluation of depreciation. Therefore, because there is no revaluation of asset, the entire depreciation of 34 lakhs will be called as other than revaluation depreciation. Therefore, entire 34 lakhs you can reduce it. Okay. Interest not paid, doesn't matter. It is not added back in MAT. Penalty, it is not added back in MAT. Proposed dividend, income tax and general reserve, all of them will be added back in MAT as per explanation 1 to section 115JB. Next, ATIA expenditure, it is not added back to MAT. Okay. Next one is a very important adjustment, amount withdrawn from reserves. But this profit was not increased by such reserves earlier. So in such case, you are not going to reduce it from the book profit. If book profit of earlier year was increased by such reserve, then you would have received this, then you would have reduced this reserve. Because the book profit of earlier year was not increased by such reserve, you cannot reduce this reserves also from your book profit. Next, 10AA, 80IA, all these profits will be part of book profit. You have to pay MAT on that. And then deferred tax credit, you have to reduce. Then there is some income tax depreciation. It's of no use now. Income tax depreciation is of no use now. What is the use of income tax depreciation? That is useful under the normal provision, not under the MAT. The only thing which is useful over here is the loss as per the books of accounts and the UAD as per the books of accounts. Whichever is lower will be allowed as deduction. Unfortunately, the lower is nil. Therefore, nil will be allowed as deduction. Nothing will be allowed as deduction. Okay. This is what this computation will be. After that, you will compute your MAT. That is 15% tax, 4% cess. I hope it is clear to all of you. Now, next question, question number B1 is on section 44. BBA, non-resident airline business. Okay. Now, there is a non-resident Mrs. XY airline company who operate from India to USA and vice versa. Okay. Now, they have collected 90 lakhs for carriage of passengers from Delhi to New York and vice versa, out of which 40 lakhs is received in New York, and the flight has also left from New York. So, out of 90 lakhs, 40 lakhs will not be subject to tax in India. Why? Because the flight has left from New York, it is accrued outside India, and the money is also received outside India. Therefore, it is not taxable. Therefore, only 50 lakh will be taxable. The redeemed income will be 5% of 50 lakh. Second, another 70 lakh is received for carriage of passengers and cargo from Mumbai to New York. Now, in this also, 30 lakh is received out of 70 lakhs. 30 lakh is received in New York for booking from New York to Mumbai. Again, this 30 lakh will not be deemed to accrue or rise in India. It is not received also in India. Therefore, out of 70 lakh, 30 lakh will be reduced. Only 40 lakh will be taxable. Therefore, 50 plus 40 comes to 90. On 90 lakh, 5% will be deemed income. Sir, what about this expenses of 170 lakhs? It is not allowed under 44 BBA. 44 BBA overrides section 28 to 43. Therefore, all the PCPP provisions will be overridden over here. Next question is a very good question. Mr. Adi, a non-resident Indian. He is an NRI. Now, remember, for NRI, which provision is applicable? An optional provision is applicable. Chapter 12A, 115C2I. Now, he is purchasing some unlisted shares, equity shares of an Indian company for 6 lakh rupees. Now, these are sold by him for 9 lakh rupees. He has incurred some expenses of what? 15,000 on brokerage, and he has purchased some few specified assets on 31st March of 3,50,000. We need to compute his capital gain. Remember, it is not clear in the question whether the shares which he has purchased, is he purchasing in foreign currency or Indian currency? Let us assume if he purchased the shares in foreign currency, then the provisions of chapter 12A is applicable. But he does not purchase the shares in foreign currency, then chapter 12A is not applicable. Let us assume that he has purchased the shares in foreign currency. So let's compute his income. 9 lakh full value of consideration, 15,000 expenses or transfer, 6 lakhs cost of acquisition, indexation is not available under chapter 12A. Then 2 lakh 85 will be his long-term capital gains. Now, to save his long-term capital gains, he has to invest in the specified assets within 6 months as per 115F. Now, is he investing in specified assets within 6 months? Yes. He is not investing the full consideration, but he is investing 3,85,000 at least. Therefore, he will get exemption under 115F, that is long-term capital gains into the amount invested divided by net consideration. This much exemption, this is one of the advantage of chapter 12A. Now, let us assume, ICAI has given both the answer. Let us assume if he is not purchasing the shares in foreign currency, then chapter 12A is not applicable. And if chapter 12A is not applicable, how the answer will change? First of all, he will get the indexation of the cost. For cost of 6 lakh rupees, he can take the indexation, and 115F exemption will not be available to him if he follows what? If he takes an assumption that the asset was not purchased in foreign currency. I hope it is clear to all of you. Let's move on to the next question, which is on charitable trust. Question number 3A. A charitable institution is registered under 12AB on 1st August 2021. It is engaged in preservation of forest. Is preservation of forest covered in charitable purpose? Yes, it is covered. Okay. Now, we need to answer whether all these items will be allowed or not allowed as a deduction, or whether it will be taxable or not taxable under the income tax law. First of all, the trust is following mercantile system, and therefore the electricity expense of the current year is 22-23. It is 1 lakh rupees. But they have paid the electricity expense in the next year. So when the deduction of this electricity expense will be allowed to the trust? Remember, for trust, the deductions are allowed only on actual payment basis. The application of income is allowed only on actual payment. Now, because this 1 lakh is paid on April 2023, it will be allowed in 2023-24. It will not be allowed in 2022-23. Okay. Next one. The trust is earning some agriculture income of 12 lakh rupees, which is exempt under section 10(1). Can trust claim exemption under section 10(1)? Yes. As per section 11 subsection 7, the trust can claim the income, agriculture income, which is exempt under section 10(1). That exemption is eligible for trust. Apart from that, no other exemption under section 10 will be allowed to a trust. Okay. Third one, a trust has earned a rental income of 3 lakh rupees. Okay. Out of which 2 lakh rupees is received in the current year and 1 lakh rupees is not received. For that, the trust has exercised the relevant option. What is the relevant option? If you do not receive the money, you can tell the assessing officer that whenever I will be receiving, I will apply in that year. Okay. So you will get the exemption in the current year. So you will get the exemption of 1 lakh rupees, which is not received in the current year, but you have to apply in the year in which you receive it. Now, by when I am supposed to apply? The law says that you have to apply in the year of receipt or the year following of receipt. I am receiving in 2023-24, so I can apply in 23-24. I also have an option to apply in 24-25. If I do not apply till 24-25, it will be deemed income of 24-25 and not 22-23 or 23-24. Okay. Next one, the trust has borrowed 45 lakhs and purchased a building. Whether it will get a deduction of what? No, no, no. If you take a loan and apply in the trust, it is not allowed. It will be allowed in the year in which it is repaid. Therefore, 6 lakh rupees when repaid will be allowed as deduction. Till then, it will not be allowed as a deduction to the trust. Next question is a simple question on DTAA. I am not interested in speaking much about it. I'll just speak about some important points of this question. First of all, there is a loss of house property. You can set off to the extent of 2 lakh rupees. You cannot set off more than 2 lakh. You can set off against the business income. Apart from this, there is a business income, there is an FD, there is a saving bank interest. Saving bank interest, you can claim 80 TTB. Why 80 TTB? Because the assessee is a resident and senior citizen, you can claim 80 TTB. Okay. Then ATC you can claim for minor son. For married son, you are buying what? You are buying some PPF. So you can claim PPF if you purchase for yourself or your spouse or your children. Minor, major doesn't matter. Okay. Married, unmarried doesn't matter. You get ATC exemptions. Then interest on PPF is exempt under section 1011, and then it is a normal sum. You can do it at your end. I'm not much interested in this question. I'm moving ahead with the next question where we need to answer whether TDS or TCS will be applicable or not. Now the first question is a good question. Mr. Ron has taken a loan of 10 lakh rupees from his employer. Why he has taken? He has taken a loan to remit for the studies of his child outside India. Okay. Now, whether Mr. Ron will be eligible for that concessional rate of 0.5% and up to 7 lakh no tax and above 7 lakh 0.5%. No. That is only applicable. I agree that is applicable for education loan, but that is applicable only if you take the loan from a financial institution in India. Mr. Ron is taking a loan from what? Loan from a private person, that is his employer. Therefore, that a concessional rate will not be available. Which rate will be available for Mr. Ron? For Mr. Ron, 7 lakh will be exempt, and on balance, he has to pay 5% TCS. Okay? Because education other than loan from financial institution, and medical is covered at the rate of 5% only. 20% TCS is not applicable even in the current year. Now the answers over here would be as per the last year, because this is last year's RTP. And this cannot I have not got the time to update this RTP. I have put as it is there on the ICI website. Therefore, it is not updated. But I am telling you the answers which are updated answers. Okay. Apart from that, he is also sent 4,75,000 for pursuing studies outside India for the out-of-pocket expenses of his child. Now, if his child is going outside India for studying, he had a lot of expenses like stay expenses, food expenses. He has to travel from one place to another. All those expenses are also required now. So for that purpose, also if you transfer money outside India, that is also education only as per the CBDT latest FAQ. Go and check our book. CBDT has given an FAQ of 7 questions where it is written that all these things out of pocket expenses will also be part of what? Education only. Therefore, this will also be subject to only 5% TCS. So 4,75,000 into 5% TCS will be chargeable on you. Okay? I hope it is clear. Now, Mr. Mandeep, whose last year turnover is 12 crore rupees and he was covered by 44AB tax audit. Okay? Now, Mr. Mandeep has purchased a house of 5 crore rupees. Is he liable to deduct TDS? The answer is yes. 194IA. He is liable to deduct TDS at the rate of 1% on purchase of immovable property of 50 lakhs or more. He has to purchase 1% TDS on that. Apart from that, he has also paid 12% commission on that particular house. So 12% commission comes to how much? 60 lakhs. Whether 194H he will deduct TDS? The answer is yes, because Mr. Mandeep is an individual and his last year turnover is greater than 1 crore rupees. Therefore, 194H is applicable, and 194H is applicable if you make the payment of commission of more than 15,000 rupees. He is making payment of 60 lakh rupees. Therefore, 5% TDS will be deducted on 60 lakh rupees. I hope it is clear to all of you. Now, the next question is the person is depositing some money with the High Court as a litigation fees. Okay. Now, High Court, what does High Court do that? If you deposit some money with the High Court put that money in the fixed deposit in the bank. Okay. Now, the bank pays interest to the High Court. Whether TDS will be deducted on that case? In that case, the court has said that TDS is not applicable. I hope it is clear to all of you. Now, the next question is exactly the same question which we have done earlier. You can go and check the past paper or past RTP. Somewhere we have done definitely same question with same numbers also. Okay. And the same item also, blanket only over there. There also it was blanket. Here also it is blanket. The same item, the same question we have already done. So I'm not interested in speaking on that question once again. Okay. Now, I'm moving ahead with the next question, question number 5, which is a beautiful question on case laws. The first case law, Mr. Surajit has filed his return on July 21st, total income 11,75,000. In the return, he has claimed 2 exemptions. One, interest from PPF exempt and long-term capital gains under 1037 exempt. And he has disclosed that in the exempt income. Okay. Now, after some time, he came to know that he failed to claim one business loss in the return of 4,50,000. So, business loss he failed to claim. Okay. Now, in the meanwhile, the return got processed. and when the return got processed, the return disallowed these two items. These two exemptions were disallowed in the return, and intimation was sent and demand was raised on the assessee, and therefore the assessee filed a revised return. But unfortunately, assessee was not able to e-verify the return on time, and therefore it can be called as an invalid return. Definitely, you have to e-verify the return within 30 days. If you do not e-verify the return within 30 days, then it is an invalid return. Now, the assessee went for rectification. Whether the AO is bound to accept the request for rectification, remember, what is rectification under 154? AO can rectify your mistake apparent from record. AO can rectify only those mistakes which are there in the intimation. Okay. Now, intimation has made which mistake? Intimation has made a mistake of not allowing these two exemptions. Okay. So, therefore, that AO will accept, the AO is bound to accept. What about this mistake of 4,50,000? That is not made by the department. That is made by the assessee. He should have claimed in the return. He has not claimed in the return. When he filed the revised return, then he is not e-verifying the return on time. So this matter is not part of intimation only. Therefore, something which is not part of intimation, that cannot be rectified by the department. Therefore, the first two items will be rectified by the department. AO is bound to rectify the first two items, and the third item, which is not part of income tax return only, that will not be rectified by the income tax department. Okay. So the AO will not rectify the third item. I hope it is clear to all of you. Next one. The assessee has taken a loan from someone. Now, when it came to repaying the loan, the assessee did not repay the loan by account pay check, account pay draft, ECS or such an electronic mode. In fact, assessee made a book adjustment with the other party, with the lender, and made the repayment. What kind of book adjustment? The lender was also supposed to give me some money, and I am supposed to repay the loan, so we made a book adjustment. Now the AO said that no, you have not made the repayment by account pay check, account pay draft, ECS and such an electronic mode. Therefore, 269T will apply. 269T will apply, and I will impose penalty under 271E on you. Now, what kind of penalty we are imposing here? The matter went to the court. The court said that the joint commissioner is supposed to impose penalty under 271E only after listing the reasonable cause of the assessee. If the assessee is giving a bona fide and genuine reason for not repaying the loan, what? By account pay check. And if book entries are made, book entries are not made outside the books. It is within the books now. Everybody can see that particular transaction through the books. We are not trying to make any kind of tax evasion. Therefore, the court said that it should be allowed to the assessee. Okay. This was a Bombay High Court judgment in the case of Triumph International Finance India Limited, 2012 Bombay High Court judgment. Okay. Now, the third case law is also a very good case law. Assessee is engaged in a finance company and it is engaged in leasing and hiring of capital equipment. So, it is engaged in leasing and hire purchase of what? Say motor vehicle or some computer, furniture, assets, etc., etc., etc. So I am a leasing company. I lease you what? Capital assets. Okay. Now, to lease the capital asset, I have taken a foreign currency loan. I have taken a loan from foreign country, and when I repaid the loan, I have to incur some foreign currency loss, foreign exchange loss. Now, I claim that loss as a what? As a PGBP expense, but the department did not allow. Department said that you have to apply section 43A and you have to add that to the cost of the asset. Matter went to the court and the court said that no need to add to the cost of asset. Taking a loan is an independent transaction. Giving the asset on a lease is an independent transaction. Don't mix it up, both of them. If loan was taken specifically for that asset only, then you should have capitalized. But the loan is not specifically taken for that asset. Taking loan is an independent transaction at a different time of interval, and giving an asset on lease or hire purchase is a different time of interval. Therefore, both of them should not be mixed together, and therefore this loss on payment of loan, repayment of loan, foreign exchange loss on repayment of loan should be allowed as what? Should be allowed as a revenue expense. Okay, should be allowed as a loss under section 37(1). I hope it is clear to all of you. Next question is again a very small question but a beautiful question. ABC Inc. is a foreign company which is in USA. It does not have any permanent establishment in India. Now, Mr. Raghu is an Indian company. Now, Mr. Raghu has made a payment of 3 lakh rupees for online advertisement to ABC. Now, of 3 lakh rupees. So, if there is a non-resident who does not have a P in India and provide online advertisement service, and if we make the payment of more than 1 lakh rupees, then we have to apply 2016 equalization levy, right? And we have to deduct 6% equalization levy. Now, 6% of 3 lakh will come to how much? It will come to 18,000 rupees. Now, on 30th June, the transaction has happened. So, I have to deduct on 30th June and I have to pay by 7th of July. Why I did not pay on 7th of July? I in fact paid on 23rd of March. So, how many months I am making a delay? From July to March, it comes to 9 months. Therefore, for 9 months, 18,000 into 1% interest per month into 9 months. For 9 months, I have to pay interest. I hope it is clear to all of you, right? I hope it is clear. 9-month interest I am supposed to pay. Now, Mr. Raghu has also made payment for another company. Another company, LMF Inc., who has a permanent establishment for the same purpose. He is again making the payment of online advertisement. Now, Mr. Raghu is making a payment to a company who has a P in India. Therefore, equalization levy is not applicable. Now, that company has a permanent establishment in India. Therefore, the income of that company is deemed to accrue or rise in India. Therefore, now Mr. Raghu is liable to deduct TDS under section 195. And if it does not deduct the TDS under 195, his expenditure will be disallowed under PGBP. I hope it is clear to all of you. And one last question over here. Let us see that whether GAR will be applicable in this case or not. Let's see. There's a company X Limited which has 2 manufacturing units. It's a repetitive question, 100 times it has come. One unit is in SEZ, another unit is in non-SEZ. So one is eligible for 10AA, another is not eligible for 10AA, and you are trying to sell the units, you are trying to sell the goods at a significant lower price to take the advantage of 10AA benefit. Okay. Therefore, my question to all of you, whether GAR will apply, GAR will not apply. In such cases, specific anti-avoidance rules are there. Domestic transfer pricing will also apply in such case. Okay. Domestic transfer pricing will apply, GAR will not apply, because wherever there is a specific anti-avoidance rule applies, GAR will not apply in those cases. And one last question over here is, we need to say whether in these 2 cases the assessee is liable to file the income tax return or not. And Mr. A is an assessee who has incurred 2.4 lakh for the wife for travel to foreign country. His taxable income is 2.25 lakhs only. So because of his taxable income, he is not liable to file the return. But because of incurring more than 2 lakh rupees for foreign travel for himself or any other person, he is liable to file the income tax return. Remember, if any person incurs more than 2 lakh rupees for foreign travel for himself or any other person, he is liable to file the income tax return. Second, Mr. B's turnover is 73 lakhs. I don't want to read the question ahead. Any person's business turnover is greater than 60 lakhs is liable to file the income tax return. Any person's professional turnover is greater than 10 lakh rupees is liable to file what? Income tax return. So by that logic, he is liable to file the income tax return. And after that, this question is a theory question. You can just go through it once and read it. This question is also a theory question. I'm not much interested in the theory question, especially over here. Okay. So this is what the compilation of 7 past papers along with 8 RTPs. Total 15 papers we have done. Can you imagine of doing 15 papers in around 4 to 5 hours? It is impossible as a student. As a teacher, for me also, it has been very painful. It has not been an easy exercise to record everything in Hindi and then the same thing in English. It is very, very difficult. English is not my day-to-day language of communication. I tried my best to communicate to you all through English because I felt that my dearest students from South India are getting left over. Everybody is making videos for North Indian students. Nobody is thinking about you all. I thought I should do it for you all, and I thought I will do little, but I will do justice with both the students equally. Whatever I do for my North Indian students, I will equally try my best to do it for you all also. I may not record all the things that are possible in this world, but whatever I will record equally for both of you. What I want from you all is, I want you all to spread this to across South India, to all your friends, to all different groups in which you are a member, to all the students to whom you know. That is the only thing that I want from you, that you have to spread it for you. Spread it for me. Okay. And I will also be coming with, I am also planning to come up with a past 10 attempts, 10 paper MTP compilation. You guys have to tell me by when I should do it. I am planning to do it by the end of this month, because the paper is on 10th or 12th, 11th, I guess. So I'll be doing it by the end of this month. You guys have to tell me by when you want it to be done. I will try my best. That will motivate me to do it faster. Okay. So till then, take care all of you. And one last thing, give your opinion below in the comment box. That motivates me to work harder for the upcoming videos. Okay. Till then, take care all of you. Bye.